Lisa Abramowitz.
Live from the nation's capital for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together with Lisa Abramowitz, who's going to return to this program tomorrow. I'm looking forward to that. She'll be here down in Washington. She's going to launch a newsletter a little bit later this morning. I'll bring you some details on that too in the next 30 minutes or so. Let's start with the price action. Equity futures on the S&P 500 slightly positive through most of this morning, going into CPI tomorrow, then on to bank earnings later this week. Equity futures on the S&P positive 0.2%. Tom, yields lower by about 3 basis points on a 10-year, 338.68.
I'm looking inside the 2-year yield. The convention within financial media is to look at the 2-year and the 10-year, the vanilla spread. You got to go inside that, John, to see the real dynamics. This was all through the zeitgeist of the last 18 hours of nudging up of 3-month paper, 6-month paper, and that you wonder how that folds into deposit flow decisions of going, do I want a high-yield CD? Do I go to a low-yield CD because I'm afraid? Or do I go to a higher-yield money market
And that
fund?
situation could get a whole lot more interesting if Citigroup has its way and their projections materialize. So let's frame the great rate debate right now. You've got the Federal Reserve, who are basically projecting in their median dot and the dot plot maybe one more hike, a little north of 5%. A market year-end pricing in a ton of rate cuts. Then Citi, 550 to 575 on Fed funds.
I would suggest they're above Anna Warren of Bloomberg Economics there. And this is what surveillance is about, folks. We're going to have Michael Schumacher with us here in a moment, who I think has a more quiescent view, with Wells Fargo on the different rate structure out there. But that's the debate here. And then you overlay that with the 60,000-foot IMF slowdown in economy. And as you mentioned, John, lower rate regime call out a number of years, and it makes for it's Bramo. I miss Bramo. Where's they got the Bramo?
A toxic brew.
It's a toxic brew. You know where I was going. It's a toxic brew.
Can we just comment on the call from the IMF in the last day or so that rates will return to the pre-pandemic level from, say, 2019, 2018? This idea that we go back to 2 once we've dealt with the inflation problems. Tom, I thought we'd spend the last 6 months or so saying things had changed and we weren't going back there.
Yeah, I don't want to go into it right now here at the top of the hour. We've got to do the data check and get to Mr. Schumacher. But, John, I can't say enough about the intellectual divide about other factors out there. Do you believe that there are depressants like technology, immigration maybe hydrocarbons that bring that yield down or not? That's a raging debate that will be addressed over the next 4 days.
Let's get straight to Mike Schumacher, the Global Head of Macro Strategy at Wells Fargo. Mike, great to have you with us, sir, as always. Good to see you, Mike. Good morning. Let's talk about the call from Citi. We'll kick things off there. Citi, Veronica Clark on this program 30 minutes ago, talking up rates of 550 to 575 on Fed funds. Mike, are you in that camp at all?
No, not at this point, John. Look, the Fed wants to hike probably once, maybe twice more, but it's really torn because it's got these obvious troubles in regional banks. Getting to 575 seems like a stretch. Impossible? No, but we're not in that camp right now.
At the moment, the conversation shifted, Mike. It's gone away from how far the Fed will go to how far they'll have to cut back. Mike, the IMF putting out its research, its outlook, suggesting that rates will return to pre-pandemic levels, Mike. Would you go that far?
No, look, the IMF's entitled to make forecasts like anybody else. But here's the thing, John. When you think about the dynamics over the last 6 to 12 months, complete shift in psychology, inflation's still stubborn in a lot of countries. I think that's going to keep rates pretty well above pre-pandemic levels for a long time. So back to 2019 levels, not anytime soon, many, many years.
Is your macro strategy, Mike Schumacher, based around service sector core not coming down? I mean, you've got a better view on headline. Core is somewhat persistent here. What does service sector core do to the Wells Fargo call?
Yeah, frankly, Tom, people care a lot about service sector core because Jay Powell cares about it. So I'm in that camp too. Mr. Powell, it's important to you. It's important to me. It's important to investors. So we've got cores staying pretty stubborn, frankly, for a while. So, yes, you probably see some moderation, maybe not so much in a couple days or tomorrow, I guess, when it comes out, but fairly soon, but still well above where the Fed wants it to be.
Right.
So we're all looking at that. We focus on it, but not anywhere near the comfort zone yet.
So if I stay on Jay Powell and look at the 3-month T-bill, and then I look at the 3-month T-bill guesstimate out 18 months, This morning, I see a very sustained 3-month yield. Does that drive even higher in the coming quarters?
Yeah, it's really interesting, Tom, to think about just how much easing the market's priced in. So it's got these two factors out there. One, inflation, bad. Fed wants to squelch it. That implies more hikes. Number two, financial system, angst, rickety structure, et cetera. That would imply a lot more cuts. We think there are too many cuts priced in, both for this year and for next year. The big test is going to come in the second part of this month. A lot of earnings releases. If the system gets past that, I think you'll see the number of cuts priced for 23 and 24 go down a lot, and that should push up things like the 2-year yield.
Bring it in close. A managing director of the IMF just emailed me and says, ask Schumacher what we see tomorrow. Mike Schumacher, what do we see tomorrow in the inflation report?
Yeah, focus on core. We've got that coming in at 0.4%. And that's probably not going to shock anybody, Tom, but we think about how the market reacts to surprises as well. And in our view, it's very skewed. So let's say core comes in hot, 0.5, 0.6. We think you get much more of a reaction to a hot print than a weak one. Because, again, the Fed wants to hike. And in our simple calculus, the Fed's going to ease only if something breaks. So core coming in at 0.4, 0.5, even 0.3 doesn't really change that aspect of the Fed's decision-making.
Two banks breaking, John, didn't get it done. We need Mike, more than that.
That's the question, isn't it? Hasn't something broken?
Something additional, John. So something broke. You've got a huge Band-Aid on it, whether it's Credit Suisse, whether it's SVB, take your pick. And now it's the question of, as your last guest pointed out, where is the strike on that put? Is that put still there? Should investors rationally think it is? Perhaps so, but you need to have, at least for the Fed to come in, or the ECB or the SNB, another big debacle out there for the markets to become even more unnerved.
Well, the immediate concern was spillover. Mike, have you drawn conclusions on how much spillover we're going to see from those incidents?
Really tough to see and quantify at this point, John. SVB seems like it's pretty localized. When you think about Credit Suisse, that's a more challenging, difficult unwind, but assuming that deal closes pretty soon, probably not a ton of spillover. But I think the bigger issue is, in particular in the U.S., you've got thousands of banks, and in particular something like 100 that range between 10 billion and 100 billion in assets. We simply don't have a lot of visibility into those balance sheets, those structures right now. Are they huge? No. But collectively, could there be a problem? Perhaps.
Well, Mike, I'll keep returning to the question I've returned to then. What are the long and variable legs of a banking shock? And is it too soon to draw conclusions? If you're the Federal Reserve and you sit there on May 3rd, do you have the incoming information, the sufficient information you need to make that call?
No, you don't know at that point. You'll know if you had an immediate problem. That's going to be evident in the next week or two. But there simply is not enough time to know, is the system really on solid footing right now? A lot of clients talk about things like commercial real estate. Where does that go? Probably doesn't look that great. Will the Fed have that information on May 3rd? No, I doubt it. What about deposit flight, deposit betas? How much does having an iPhone and a fancy app change those betas? Well, they get faster, they get higher, but to what degree? We can't tell. Neither can the Fed quite yet.
Mike, John Williams of the New York Fed said, basically, it's not our fault. It's not because we went from 0 to 5% in a space of 12 months. We didn't have anything to do with this. These incidents, idiosyncratic. Mike, would you take the same page as John Williams over at the New York Fed?
Well, I think you've got to focus on monetary policy versus the Fed's regulatory authority. And does it make a lot of sense to have those really embedded in the same institution? We did a call recently with Sheila Bair. She said no. They should be split to some degree. So monetary policy, yes, it's been aggressive, but frankly, the Fed waited a long time to get tough, too. It could have moved certainly back in 21. I think that would have helped quite a bit, and it chose to wait.
Mike Schumacher.
Oh, there goes his governorship.
Mike Schumacher. Thank you, sir. A lot of people share that view. I keep going back to it. The language that the Federal Reserve used, I think, was misplaced, and it was wrong of us to echo. This wasn't front-loading. It was back-loading. They had to go quickly because they were late, not because they were trying to get out in front of anything. There's a big difference there, Tom.
I call it the slew rate, which is, electrical engineering 101. And the bottom line here is, to your point, on the x-axis, they delayed, boom, up they went. And so what do you do now? And, this is why I keep bringing up pause is an easy solution that gives Jerome Powell optionality. It's just vapor.
So Mohammed Al-Arian wrote in to both of us, actually, on this point, Tom.
He's speaking to me?
He is. Later this week, too.
Exclusive.
he said a couple of things, and there's basically going to be three potential scenarios now. You can pause and then just pause through the rest of this year. You can pause and then start cutting, or you can pause and then you need to start hiking again.
Yeah.
That's the problem.
This was heated. Steve Risciuto, I can't remember, John, if you were there yesterday. Risciuto Mizuno was heated that he does not agree with Lazzetti of Deutsche Bank. Matt Lazzetti says they're going to cut off of pause. And Risciuto was heated. It's not asymmetric. They can go either way.
Can we promo Bramo's newsletter?
We have to promo. We're not doing it enough. She just emailed in.
It launches today, the surveillance newsletter, written by Bramo with a flavour of gloom every single day. I'm sure you're all looking forward to it.
I love that
title,
Flavour of Gloom.
Flavour of Gloom,
that
or the
works.
Daily Anxiety. We'll figure it out as we go.
Anxiety too.
You can sign up at bloomberg.com/newsletters. So that's bloomberg.com/newsletters.
Is it
very
Substack
cool.
where she's like making a fortune off this?
On the side, she's going to do, I hear she might do subs in the future.
Substack?
Yeah.
I haven't done that. I don't.
She's going to take a paid monthly subscription and put out the Daily Gloom.
There's a newsletter there. It's going to go into a number of the themes here. Obviously, the anxiety will be there if Lisa's driving the bus, but you know, the answer is there's a lot of different themes. It's positive. Look at Veronica Clark, Michael Schumacher.
I know.
There's the difference.
Just to be very clear, Lisa's not taking paid subscriptions, just in case anyone thought you had to pay. It will be free. You can sign up on bloomberg.com/newsletters. In the next hour, Alicia Levine of BNY Mellon. That's all coming up shortly from Washington. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Pentagon says those leaked documents that detail U.S. spying on other countries is a risk to security. The papers include an assessment of weakness in Ukraine's military. The Pentagon is conducting a damage assessment. Meanwhile, the Justice Department is trying to find out who leaked those documents. In North Korea, Kim Jong-un has called for what were described as practical and offensive war capabilities. That came as Pyongyang cut off communications links with South Korea used to reduce tensions on their border. This year, North Korea has tested new weapons and systems to deliver nuclear strikes against the U.S., South Korea, and Japan. In England, the state-run health service is bracing for its most disruptive strike yet. Tens of thousands of junior doctors walked off the job today for 96 hours. They're joining other public sector workers who are demanding bigger pay hikes to make up for inflation. And billionaires Tyler and Cameron Winklevoss are using their own money to support their crypto exchange, Gemini Trust. Bloomberg's learned the twins have made a $100 million loan to Gemini. The firm has faced numerous setbacks during the year-long market downturn for digital assets. Warren Buffett is turning his focus back to Japan. Berkshire Hathaway has kicked off a yen bond sale, and Buffett told Nikkei he plans to boost his investments in the country. Shares of Japan's major trading houses jumped after Buffett says he's raised his holdings in them. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Our studios in New York and San Francisco. our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This week, surveillance is live from Washington, D.C. as part of Bloomberg's extended daily coverage of the World Bank Group and International Monetary Fund's spring meetings.
These meetings, even with the banking crisis in place, are really, really important.
Economic outlook, poverty eradication, aid effectiveness, and more.
How slow could global growth get?
You could have a global recession.
Live coverage throughout the day continues all week on Bloomberg, your global business authority.
The president has been briefed. He was first briefed late last week when we all got word that there were some documents out there. We don't know who's behind this. We don't know what the motive is.
At this point, do you believe the leak is contained? Are there more documents out there that have not been released? Complete? Is this an ongoing threat?
Truly don't. I truly don't.
What a story down in Washington for John Kirby, the White House National Security Council spokesperson, referring to a recent military intelligence leak. We'll catch up with AMH in just a moment on that. If you are just tuning in, welcome to the program. Here's a flavour of the price action for you on the S&P 500. Futures through most of this morning, positive so far on the S&P 500, on the NASDAQ, on the S&P, just about positive at the moment by about 0.1%. The bid returns to the bond market. Yields are lower by a couple of basis points on a 10-year, 3.39 on a 2-year yield, which has been dancing all over the place over the last month or so. 3.98. We're down about 3 basis points at the front end of the curve in the FX market. Stronger euro here, weaker dollar, euro dollar just north of 109, let's call it 109.20. Positive here, Tom, by 5 or 0.6%.
Maybe quiet into the inflation data tomorrow, John, maybe just churning here as well. But the short-term paper market is doing more than churning. And again, it goes back to at what level is this banking angst over? And the answer is, I don't think anybody knows.
The deposits woke up to 5% interest rates available, Tom. We've seen a lot of deposit flight, and it's not just about, as Peter Chu of Academy said on this program in the last 24 hours, that deposit flight is not just about perceived credit risk at individual banks. Tom, it's about interest and interest available elsewhere.
It is, and you're just going to have to see what happens there. What we've been doing is research. We do surveillance research here when we come to Washington, and the real question is, which of the Bourne movies is more important? Matt Damon, The Bourne Identity, The Bourne Supremacy. Amory Horton has seen them all. She's Bloomberg Bourne Identity correspondent and joins us today. We want Matt Damon to come to the rescue here. The movies are the CIA like this. The movies are the intelligence community like this. He drives a very cool car.
Like you.
What's the reality right now? It's not Matt Damon and The Bourne Identity.
No, certainly not. This is a difficult moment for the administration. This is potentially the biggest data breach since Edward Snowden. And a lot of this has to do with U.S. allies. So what you see from South Korea, a very difficult moment for their leader who's coming here for a state visit. And the opposition is saying, but the United States is intruding on our sovereignty. At the same time, they don't know if this leak is done. And there obviously is a Department of Justice investigation to find out how did this happen. The biggest documents, revelations the documents have, potentially some are saying that they could have been doctored, but the biggest really comes to the war in Ukraine. And the issue going into the spring, and we know that Russia wants to have this fresh offensive, is that will they now capitalize on this vulnerability of these leaked documents out of the United States?
But what's important to me is in the movies, it's under a bench in East Germany with some papers or something in a 35-millimeter roll. This is the new internet they're all dealing with. And frankly, it goes back somewhat to the classified documents uproar with former President Trump and frankly others. The whole issue is modern technology in the intelligence community of Washington. Is anybody dealing with this?
Well, right. They had the hard printouts. If you're talking about the classified documents, the former president and current president, that there are also special counsel investigations into, these were hard documents. But as opposed to those, these intelligence documents were leaked on the internet, things like Telegram. That's where they are surfacing.
To be clear here, they were linked months ago.
Yes.
We just didn't realize they had been leaked. Is that right?
Yes.
How unusual is that?
And there's, some of these are obscure sites, and also some of the stories are coming out even today. We're learning more and more. So today, the Washington Post is an exclusive from these leaked documents about what Egypt was trying to do, which was sell rockets to Russia, but to make sure that the United States wasn't going to be aware of it, to keep it basically on the down low, because Egypt is a huge recipient of U.S. aid. So as the days and weeks progress, I think there's a lot more we're going to learn from these documents, and it's causing a huge headache for the administration.
Terry Haynes of Pangea came on the program in the last hour, and he said, we all spy on each other.
That's true. We learned this a decade ago with Angela Merkel.
But can we be outraged about Chinese spy balloons floating over the country at the same time we know this has been going on?
Yeah,
it's a great point. If we know we're all spying on each other, then I guess the global community leaders need to accept it. But of course, if you have the issue with the balloon, obviously, was that it was obvious to the naked eye that this was over the United States and over critical military infrastructure. This is something that we know is happening, but you don't always see. And now we're actually seeing it. The question is, what is the fallout? Does this at any point compromise how the U.S. gets this intelligence, garners this intelligence?
What's so important to me here, and John, the Cambridge Five is Mohammed Al-Arian and 4 others that root for Queen's Park Rangers.
Are you suggesting he's a spy now?
Five, yeah. But the Cambridge Five is from 1963, and Kim Philby. And John, we grew up in America with this arrogance that our intelligence community was far superior to those crazy Brits. That's gone, I would say, with Snowden and now this mess.
Yeah, I would say so. Although these, like the UK, the United States, you're saying the crazy 5 Cambridge, or you're talking about the 5 Eyes, they share intelligence. So there is concerns as well for those countries that share a deep amount of intelligence with the United States that potentially are some of their methods and sourcing or intel is also breached in these leaked documents.
You mentioned something important, intelligence gathering. Has it been compromised in any way, shape or form? Have we compromised any individuals with this leak?
We don't know yet. That's what this entire Department of Justice investigation is about. And that is why the U.S. administration is concerned. And their allies are also concerned, but they're not trying to have this public outcry. They're trying to do this behind back channels, through diplomatic back channels, to try to save face, but it is a huge issue.
To be clear, with the Washington Post headlines today, they're really catching up with 5, 6, 8 stories, whatever. Did you say that we don't know if it's all out yet? There may be more stuff to come.
Well, we have a new story on the Washington Post exclusive about Egypt. Potentially the documents, as Jonathan was saying, are out there, but we haven't gone through all of them to see if there's any new stories.
So which one's the most controversial at the moment, away from Egypt? What do you think is the most controversial thing that's come out?
The most controversial is regarding the war in Ukraine, because this could have serious consequences on how the rest of the year looks. In terms of the spring offensive Russia wants, the fact that the U.S. doesn't think potentially Ukraine has the defense it needs to fight this off, this is a capability that Russia could really jump on.
Does it have reservations? Does the United States have reservations about leadership in Ukraine?
Well, I think this is more about the status of the Ukrainian military. That's what these documents are showing.
What is the status of the Ukrainian military when I saw a headline this morning that the Russians have 75% of a grievously fought over city?
The concern with the Ukrainian military is that they're not going to have the ammunition they need,
Literally
the Soviet-era ammunition. If you remember, Dmytro Kuleba, this isn't really, though, shocking to anyone. He had said at the Munich Security Conference, if the prior year was about we need weapons immediately, this year is about ammunition and the speed of that delivery.
Just amazing when you find out these things, Tom. We kind of know these things happen, but when you find out these things to this degree, Anne-Marie, you realise just how effective some intelligence gathering actually is. Yeah. The level of detail that the United States has on individual countries, just remarkable.
Yeah, and to be clear, I think the whole media, and I know it's surveillance, we feel this strongly, we're not going to speculate and guesstimate what that level. You mentioned the balloons. I mean, there's all sorts of rumors we didn't talk about with the balloons because they were, not supported.
What we said at the time, Tom, and I remember talking about it, who was the outrage for? Was it for China or for public consumption? And there was, to some degree, it felt like it was for public consumption because the administration was aware, Anne-Marie, it was happening.
And remember, Secretary of State Antony Blinken was scheduled to go.
He had a trip planned even though he knew this kind of thing was happening.
Yes, the issue, of course, with the spy balloon was that it became public.
AMH, awesome to catch up,
Alleged.
as always.
We should say alleged Chinese spy
As
balloon.
always, you can fit
Very
that word in,
alleged.
of course. It's alleged because the Chinese Communist Party said it's not
It's
for spying.
alleged we're going to get through
What was it? It
this
was for
hour.
weather, right?
Yeah.
Okay.
Climate.
Okay. The alleged weather
Is this where they film Balance of Power?
It is.
Oh,
is
my
it.
You're
word.
sitting in my
Goosebumps.
seat.
I'm sitting in your seat. Oh!
Whose seat is this?
That's Joe's.
Josie.
Nice. Well, thank you, Joe. I appreciate that. Okay, from Washington through the week in Joe and Anne-Marie's seats. Equity futures unchanged. This is
Is that an HR
Bloomberg.
violation?
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Is it too early for the countdown clock for the inflation data? I believe it's about 25 hours away. TK loves this stuff. 25 hours to go.
Can we get a Ben's Chili Bowl countdown clock?
That's about
that? Up on
3
your
hours
street?
away.
Yeah.
3 hours away? 3 hours away, maybe. From Washington, D.C. this morning, good morning to you. Here's the price action at the moment on the equity market. Futures slightly positive through most of this morning on the S&P. Now turning just a little bit negative on the NASDAQ. We're down about 0.2%. The S&P 500 totally unchanged. We've talked about the data this week. CPI tomorrow. You'll get Federal Reserve minutes as well. Later on in the week, some bank earnings in the mix as well. Michael Hartnett of Bank of America. Investors are too optimistic on rate cuts, not pessimistic enough on recession, capturing some of the recession talk, the move in the bond market over the last month or so. Just an aggressive bull steepener, which basically means you've got a big rally at the front end of the curve. We've gone from north of 5% to south of 4%. Had a look at 360-ish last week, Tom. Right now, 398.69.
Let's stop the show and partition the brilliance you just said, which is it an interest rate and monetary analysis, or is it just the blunt instrument of economic slowdown? And that's what Mr. Hartnett's talking about, is forget the Fed mumbo-jumbo, just on a GDP basis, we're not going to be there, which channels what we're hearing from the IMF.
I'll keep returning to the conclusion, the consensus view after the banking stress of the last month. The view was that would turn into a disinflationary bust. And that was captured in the bond market pretty quickly. The 2-year goes from north of 5 to south of 4, has a look at 360 last week off the back of a week of weak data, Tom, so to speak, in the U.S. economy. And then payrolls gives you a lift again at the front end of the curve with a bit of an upside surprise. But, Tom, ultimately, that's the call at the moment, and you can take a different view if you want. The Federal Reserve's certainly taken a different view on things. They think they can get rates to north of 5% and hold them for the rest of this year.
I think we're setting up here, folks, for the different views. And again, it goes to the inflation report. And I want to make clear, we are in Washington, but we will continue with our global economic, finance, and investment coverage here around international relations. Someone who does that each and every day in the Beltway with Rock Creek Group as Alifia Darwala, Managing Director at Rock Creek, really managing money, listening to institutions, and where to place the next marginal capital. You dovetail, it's actually like your beloved Georgetown, you dovetail economics right into finance and investment as well. Are you petrified about an IMF call of OMG, global recession?
I think, the IMF came out in October, but we've also seen some contrary opinions out there, right? And then you look at the equity markets, you look at the disconnect between equity markets and bond markets, both telling you extremely different things, and I think it's a little puzzling out there. I do think, unfortunately, there's more downside in the equity markets than there is upside today, whether or not the IMF is right on their 5-year, 7-year calls in terms of global GDP forecasts.
So where are you in the equity market? Are we in all cash? Are we in the triple leveraged all cash fund? Or can you participate in the equity markets given your caution?
Well, last year cash was one of the best trades out there, right? Or the 6-month T-bill wasn't a bad place to be, was probably the best trade of a lot of institutional investor portfolios. We are defensive and pretty cautious on equities. That being said, you have a long-term portfolio, you can't be out of the equity markets. And you would have missed, what, an 8% rally, 20% rally in the NASDAQ if you were
Yes, I did.
Quarter.
So the bond market is basically saying rate cuts, and the equity market, to some extent, is conveying this idea that rate cuts are good because the NASDAQ will do well, growth will outperform, tech will deliver, and that's what we've seen here today. Are you on board with that on the tech side of things?
I think the tech, could have been a little bit of a dead cat bounce. I think we saw a lot of investors overselling probably last year, those that are longer term, that want to be in these tech stocks longer term. If you look at active management, you have a bias towards growth, right? And so most of these big money managers are going to have to be in some of those large growth stocks. And if you look at the very big tech, let's say the top 5, cash on the balance sheet, lots of layoffs, lots of massive cuts, you could argue that they're not in a terrible position for the rest of the year. The question is, what about the rest of the tech sector, and then let alone the private sector in tech?
So let's get a little bit more specific. So I can look at Meta. They talk about the year of efficiency. The stock has done tremendously well year to date. Tesla, another name. Some difficulties over the last week or so, but year to date, I think still up about 40% or so. Within tech, which is just a massive monster universe, what do you think is vulnerable?
Yeah, I think definitely you have the larger tech, which is not as vulnerable as those smaller companies that are going to really be, very much prone to consumer demand and an economic recession. And so if you get an economic recession, you're going to see the majority of smaller tech companies really struggle to survive.
The soul and the heritage of Rock Creek Group is what I'm going to call a global hydrocarbon template overall. Fold in when OPEC Plus with a surprise, I think 10 days ago as well. Fold in how hydrocarbons affects your equity belief.
Well, I think not necessarily specifically on the equity side, but it affects our portfolio longer term in terms of how we're positioned, right? We definitely are positioned longer term to benefit from climate adaptation, climate transition, renewable energy, all of those themes, mostly on the private side, but also a little bit on the public side. You saw that some of those renewable energy companies had their best years ever last year, a little bit more trouble more recently, but I think longer term, that is where you want to be. If you just look at the future in terms of the 5-10-year time horizon, that is where companies are going and their business models are going to have to change.
Unfair question, but we got to make some news this morning. Does big oil have a future?
I think big oil will always have a future, but depends on what you define as big oil. That might change.
What would you define as big oil? Why do you think that would change? Talk to me about that.
Well, I think in 5-10 years, big oil might have a large percentage coming from hydrocarbon, from renewable energy sources. I think it'll have to have alternative energy sources to diversify its business.
Last year, we saw a bit of a spread emerge between the US players, massive outperformance in the equity market, the big integrated oil majors, versus the European players. Now, the European players still had a decent year, but relative to some of the US names, underperformed. Do you think that's because the US names were a purer play on fossil fuels relative to the European names, which have gone elsewhere?
I think there was also some macro headwinds, right? I mean, you looked at all of the tensions in terms of Europe, the effects from the Russia-Ukraine war, energy, winter, all of those. I think that was probably a little bit more of a macro headwind, potentially for some of those big European oil plays versus the U.S., which are a little bit more isolated.
I'm just wondering, the reason I asked that question is I'm wondering from your perspective, which of the oil majors are better positioned for the transition that you're expecting? Where do you think some of these names need to be in the future?
Yeah, I think some of the European players, though, are far ahead in terms of that area. I mean, I think it's undeniable if you look at what Europe has done and all of the investment that they've made, that, some of the U.S. players are probably behind and are starting to try and really catch up because they know where the future's heading.
How do you process the tension and the bipartisan tension of the United States of America with China right now? Is there a strategy for investment given this new friction?
It's a topic that comes up with all institutional investors. China has been a major part of asset allocation, thinking about it with China over the last 10 years.
So how do you then go out 5 years?
I think that's really shifted, and I think there's a lot more negative or caution on China. And does it need to be as big of a play in your emerging markets portfolio, or are there places like India over the next 5 years that'll take that role?
Big change, Tom.
We could go like another 30 minutes there on China to India. Tim Cook, good morning, Mr. Cook. You want to expand on that for Apple, please?
Well, I think Apple already knows where the future might be heading.
Thank you.
They're very subtle about what they do. I'm just tremendously impressed by Tim Cook. Tim Cook, with the previous administration, was just never in the firing line with the Trump administration. Managed to avoid all the heat and fire, everything, all the fury. Was just never in the firing line. And then a new administration, and he still looks really comfortable.
I think it goes back to the wonderful Mr. Jobs. There was, and frankly, I'm not going to mince words here. Part of it was because this was a Syrian immigrant who founded this incredibly successful, once-in-a-lifetime company. And the answer is they've always had a distance and reticent from the news flow.
Mark Gurman of Bloomberg, of course, wrote that fantastic story in the last week or so about how China, Alethea, how Apple is trying to pull back from China, but doing it in a diplomatic way so they don't trigger anger in China. What do you make of Apple's ability to do these things in a way that other companies seem to struggle to?
Well, I think you also have to redefine pullback, right? I mean, that's going to be a slight pullback. No one's leaving China. It's too big of a market. They can't, right? If you're Apple, you have to be there. But I do think their incremental investments are going to be all over.
Is India an analog to China, or is it its own beast?
I think it's its own beast if it can get out of its own way. I think they also obviously have a lot of political challenges.
Alethea, this was great, as always. Alethea Dorowala there of Rock Creek Group. Tom, on tech, on energy, the equity market, on all of the above.
Well, this is what Rock Creek invented here. I mean, Ms. Beslosh and the whole crew, they just wrapped it around a geopolitical discussion. It's what people listen to down here. It's why you've got to synthesize. I mean, take Lisa's kids. They're on the couch doing the Robin Hood meme thing. You got to synthesize World Bank and IMF analysis into what do you do with AMC and GameStop.
The big development, Tom, I think, in the last week still is the words of Macron on China and the daylight that he's put between the United States and Europe. Now, whether you think that's just a lone view of a man trying to make some news on the international stage because he's got problems at home, I think that's maybe the cynical take. I wouldn't go that far. I think he truly meant what he said. about the relationship with China that he'd like to see that Europe might have.
And I've been remiss not to bring this up, and you've been great about bringing it up, and I 100% agree. There's a Frenchness here to what he's saying that harkens back to de Gaulle ages ago. You're not going to fly your jets over my country. That's what it was 50 years ago.
The criticism that he's received, though, after the last weekend, I think is really, really
particularly important. On Taiwan. Yeah.
This is exactly the kind of thing that the Europeans used to say about Russia. And they've ended up with a bunch of stranded assets and a misplaced energy trade that leadership after leadership across the European Union has built up. Now, Angela Merkel in Germany was warned about this repeatedly for more than a decade. And what have we experienced over the last 12 months because of that? And I think where those words might come back to haunt the French leader is on the very topic of Europe itself. Because at the same time, you can't say we won't just follow the US into a crisis that does not belong to us, when you are also expecting the US to follow you in Europe for a crisis that many people in this country, Tom, are arguing does not belong to the United States.
Oh, yes.
It belongs firmly in Europe's backyard.
Yeah, the other thing I would say is he's fighting for his political life. My amateur take is on the domestic front, he is more than challenged. And it's not just about adding 2 years to the retirement age. They're going from 50 to 52.
50 to 52.
50,
I thought it was from the 60s and higher.
No, I think it's Paris. It's like.
Can you imagine if you could retire at 50?
No, I could not. That was so long ago, John. I cannot imagine that. Thank you for bringing that. Leaf is looking at us like, are they always talking about?
Well, I think a lot of my generation are thinking we're just never going to retire. Leafy, thank you. Leland Mitter's coming up, the co-founder and CEO of the China Facebook International. We'll talk a little bit more about China and focus on the economy as well. Just a sneak peek at the market for you. Equity futures turning lower in the last 30 minutes or so. I'd say the last hour. Equity futures down about 0.1% on the S&P. Yields just about unchanged on a 10-year, 3.41 on a 10-year yield in the FX market. Euro stronger, dollar weaker, euro dollar 109.09, positive 0.5%. From Washington, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden will head to Ireland today for a long-awaited return to his ancestral home. His first stop is Belfast, Northern Ireland, where he'll meet with UK Prime Minister Rishi Sunak. He'll then travel to the Republic of Ireland to mark the 25th anniversary of the Good Friday Agreement and celebrate the recent Brexit deal. Senate Democrats want an investigation into undisclosed luxury trips that Supreme Court Justice Clarence Thomas accepted from a wealthy Republican. They've asked Chief Justice John Roberts to conduct a probe. Senate Judiciary Committee, controlled by Democrats, will soon hold a hearing on the court's ethical standards. In China, the government plans to require a security review of ChatGPT-like bots. Providers of the generative artificial intelligence services must ensure content is accurate and neither discriminates nor endangers security. That casts uncertainty over AI bots unveiled by China's largest tech companies. A setback for Moderna. The biotech company says a final stage study of its first experimental flu shot hasn't accumulated enough data to determine how well it works. So now Moderna will start a study of an updated version. A flu shot is crucial to the company's future. Its COVID vaccine sales are expected to drop off. And Apple CEO Tim Cook heads to India next week, where he will open the company's first stores there. That underscores Apple's ambitions for the country as a growth market and a manufacturing base. Sales of iPhones in India have reached an all-time high. Meanwhile, annual exports of iPhones assembled in India have reached billions of dollars. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We still have that terminal rate at 5.5 to 5.75, so that's a 25 basis point hike in May, another in June, another in July, and again it comes down to this timing issue. You need people to stop spending, you need credit to contract, and that's what slows the economy and brings down inflation.
It's a feature, not a bug. Veronica Clark, economist over at Citigroup, looking for rates to get close to 6% over at the Federal Reserve. 550 to 575, still the call from Andrew Hollenhorst and the team over at Citi. Welcome to the programme. Here's a flavour of the equity market for you. Just a brief snapshot of things in the equity market at the moment. Futures turning lower. In the last 40 minutes or so, we're down not even 1/10%. We're down about 0.04%. Elsewhere, into the bond market we go with a 10-year basically unchanged. Your 10-year yield, 341-ish, 340.93 on a 2-year at the moment. A 2-year yield comes in a single basis point, just short of 4%, 399.74, getting closer to that 4 handle this morning and backing away from the move lower we'd seen in yields a little bit earlier on this morning. Just want to finish up in the FX market with the euro just north of 109 against the US dollar. Euro dollar 109.07, Tom, positive 0.4%. The next stop, we've repeated it this morning over and over again repeatedly. CPI coming up tomorrow, Fed minutes as well, and then onto the bank earnings through the week and on to Friday.
And the split there on CPI tomorrow between core and headline, it's been there before. It's not a new idea, but maybe it's a more predominant idea now that you may get a good headline, but core, even the people away from Citigroup are saying you may get a Citigroup-like core to provide some angst.
And that should keep the Fed in the game on May 3rd. That's the view. But given how quickly things have changed over the last month or so, this is still a few weeks away.
Exactly. I think
things can change just as fast.
Three more times before we go forward. This is a treat. If you're at the International Monetary Fund, you're going to lean forward and listen to Leland Miller. He is co-founder, chief executive officer of China Beige Book out of the Washington and Lee UVA Combine. Leland Miller joins us of China Beige Book. I'm just going to cut to the chase. You're right about consumption. They're not 70% of GDP. What's consumption in China? It's a lot less, right?
It's a much smaller share than these pies that they like to print. Consumption is structurally weak in China because they don't incentivize consumption. The state represses households, it represses private firms, and so consumption has a very hard time ever getting a pickup. They've ramped down investment, but incentivizing consumption has been a very difficult task.
How do you respond then to World Bank and particularly IMF 5-year global GDP, shockingly subpar, 3% or less, and they'll say, yeah, India and China have a buoyancy, but everything else is weak, and you're modeling out a China that's less than buoyant, right?
I think so, yeah. I mean, 2023, we're going to go into better economic numbers in the coming months, no question. But it's going to be a head fake because what the most dominant model for China going forward is one of significant structural slowdown. And this is something in which the party has given up on the high levels of growth. It's not focused on prioritizing growth at all costs. It wants to strengthen the core. It wants to tamper down its debt levels. So at this point right now, the entire focus is how do you get China through the next economic model into something more sustainable. This is much slower growth going forward.
What kind of levels of growth do we need to get used to? 3?
3 to start with, down to 2, possibly down to 1.
Wow.
A lot of this will be in China. This will be a reflection over time, over the coming years, be a reflection of what global conditions are, et cetera. But, there are numbers that they can announce, and there's numbers they can't announce. If they fall off a cliff and they don't have something like COVID as an excuse, then everybody will panic. So they can't announce certain numbers, but the amount of growth they can do, now that they have diminished the role of the property sector in driving growth, there's no replacement growth driver. And consumption's not going to pick up the slack. So what you're dealing with is much slower levels of growth. In order to get the number enough for it to be politically palatable, you got to stimulate a little bit, but you're not stimulating like you used to in the big stimulus sense. So the number is going to be much lower.
So high unemployment in a place like the United States, a democracy, is a threat to the political future of the individual in the White House. In China, it's an existential threat to the Communist Party, the whole regime, the system. What kind of levels of unemployment, what does the rest of the economy look like as you transition from 5, 4, 3, 2, and maybe even, as you say, down to 1% GDP growth?
Demographics are an enormous headwind for China, but in the short term, they're very salutary, because when you have fewer people in the workforce, you have fewer people, fewer population growth, you're going to have less of a problem with employment. It's going to help ease the trend. So in the short term, the fact that China has all these working population headwinds, it's going to help the transition if they do it right. But it means the long-term picture is going to be extremely challenging.
What is their fiscal space? If somebody walks in behind those red doors into the leadership's offices and say, we're modeling, sir, 3% national Chinese GDP, in America, somebody goes, fiscal space, let's go, get to work. Do they have fiscal space? Do they have the normal mechanisms of stimulus if they need it?
They do, but they're very concerned about overusing them. If you look at what's happened for the last 3, 4, even 5 years, there's been much less a reliance on stimulating into weakness. I think that the entire stimulus playbook has changed because the party says, look, we want to be in power indefinitely, and we don't know when too much debt is going to be too much debt. Everywhere else, people are in there for 2, 4, 6 years. They don't care. They're going to do their spending, and then they're going to get out. In China, said we have to have a long-term sustainable solution to how we spend. We may not be at the end of that road. We don't know where on the road we are at, so they are pivoting all their economic policy making.
What is the distinctive feature of your micro research right now? China Beige Book is acclaimed for electricity receipts in Chengdu, just as one example. What's the micro data now that our audience needs to know?
Credit. A lot of, we look at the PMI, you look at GDP growth data, and everyone's talking about growth. How much is China growing? But the best lens into China is always credit. And what we saw in the first quarter was amazing because it was the biggest single one-off drop in credit costs that we've seen in the history of China Beige Book. Over a decade of data, rates just dropped through the floor. And they dropped where? Retail, services, private firms, SMEs, all the places that China really wants to get an oomph to. So we have been very cautious about saying that the government's providing policy support to the economy for several years now. There is policy support going to the economy right now. It's one reason we're much more bullish on Q2.
We always suggest that China has control of its destiny, that they can just pull different levers and ultimately end up where they want to end up. Any sign that they've lost control on the direction of this economy?
No, I think they are maintaining control of the direction of the economy, but this depends on an understanding of where the economy is going. The old growth levels, anywhere near the old growth levels, are no longer possible. They could be possible in the short term in order to juice growth, but it would have long-term consequences. They are going to much slower growth going forward. A non-commercial financial system like China can peg up those holes and make sure that the ship doesn't sink. Yeah. But it means that you're dealing with much slower growth over time as you're chasing non-productive.
Tom asked the right question. What would you look to? Tom talked about electricity in one particular city, and you mentioned credit. Where can I get reliable data on what is actually happening in the economy, which is why we used to look at electricity usage back in the day, because people didn't believe you could trust the GDP figures. You mentioned credit. Where would you find reliable information?
Well, look, I mean, there's not that many good sources of data right now. And Bloomberg, of course. Yeah, Bloomberg, of course. And China Beige Book, of course. But, the problem here is that when there are these macro indicators that are used as proxies for the economy, Beijing gets it, and then they start manipulating that data.
Very quickly, Liz Economy, the river run black, she changed the dialogue of China. She's always said Xi is weak domestically, fragile domestically. Do you buy it?
Well, he's undergoing enormous challenges right now, but it doesn't mean that Xi is weak to the point where he's going to lose control. But it does mean that when you're associated with where the economy's going, with where China's going, with the, with China's international image so much, it means that you have many more challenges at just being a leader of a country. You now represent China on the international stage.
We've talked a lot about Macron's visit over the weekend. What was your response to that, your reaction?
It's the French being French. I mean, I don't think that there are many people writing op-eds about what a beautiful strategic stroke this was for Macron to do it. That there's this chasing after the idea that, hey, the U.S. and China are great, but France is important too. I think we can look at the international stage and see the problems with this.
On radio, you're not going to see this. On TV, don't do this. We don't want Miller, full colon. It's the French being French. We just don't want to see that.
Leland, thank you.
We'll never get into the French embassy again.
We can leave that there. Leland Miller there of China Beijberg International. Your thoughts on that?
It's just brilliant, and this is the guess that we do. This is when we invented surveillance, John. This is what we want, is really knowledgeable people, always opinionated, always differing in opinion. And on China, and that you talk about the code word for Georgieva, a fragmentation.
Yeah.
The fragmentation between China and America is tangible.
The conversations continue down here in Washington, D.C. Up shortly, in about 10 minutes from now, we'll catch up with Alicia Levine of BNY Mellon Wealth Management. In the equity market on the S&P 500, we're just about negative, just. From Washington, this is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
for the Fed's perspective, from a macroeconomic perspective, there simply is still a very clear indication that the labor market is tight.
There were some mixed parts of the data, but if the Fed wants to go, they've got the excuse to go 25 bips.
It feels like we have one more hike in the cards for the May meeting, and the Fed keeps policy stable for the remainder of the year.
We've never seen this much tightening without a recession.
It's going to be maybe a deeper recession that people give it credit for.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
With you from the nation's capital through the week, live from Washington, D.C. this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Your equity market futures just turning negative in the last 45 minutes or so on the S&P 500. TK, things just warming up down here in Washington. Things will get a whole lot busier as the week grows older.
I'm glad you bring it up. Let's wander through the week. I think this week, today is rather more general. Tomorrow, even at the IMF and the World Bank, they will parse United States inflation. It's that important, frankly, on an international basis. And then with a vengeance, we really get going after the World Economic Outlook presentation, I believe tomorrow into Thursday and Friday, to have much more to do with the shocking, not gloom, but just the caution the IMF has about the path forward.
And the attention, Tom, increasingly as well will turn towards the financial system as we talk about the bank earnings and reflect on the shock we've seen over the last month.
I agree. This has to be overplayed here. It's a different IMF World Bank meeting, and it has to do not only with the banking tension here, but a distant memory of, I believe it was a Swiss franc that was challenged a while back.
Yeah.
That's sort of unspoken here, but nevertheless, there's Credit Suisse to remember.
12 months ago, we were talking about hiking into high inflation, central banks around the world needing to do more. 12 months ago, are we running the risk of hiking into a crisis, whether it's the ECB and the Federal Reserve, after doing a lot in a very small amount of time, a very small window, 12 months, 0 to north of 4%, approaching 5%. John Williams in the New York
That's right,
Fed
where I was going to go.
Talked about this at the NYU at New York University overnight, Tom. John Williams mentioned that he does not think that the banking fallout of the last month is in any way, shape or form connected to the speed, the rapidity in which they raised interest rates over the last 12.
I don't know about any. Well, here we have it on the radio. I personally don't think it was the case that the pace of rate increases was really behind the issues. At two banks back in March, I think it's well understood there were some pretty idiosyncratic specific issues with those institutions. The distinction here is Olivier Blanchard would say maybe it's not narrow and idiosyncratic, but there's other larger issues going on than just worrying about the ISLM function in Hicksian economics.
Well, they've still got to deal with the consequences. And we need to think about the ripple effect of the shock of the last month, Tom. Some, and we mentioned this earlier, including Citi, Veronica Clark, Andrew Hollenhorst, making the point that they believe that any spillover is likely going to be contained and limited. Others think the credit crunch has started. Now, where you come out on that is going to shape your view on how far you think this Federal Reserve can go. If you're in the former camp, Citi, you think rates can go to 550, 575. Right. If you're in the latter, credit crunch, Apollo, others, you think perhaps the last hike of this cycle has already been delivered. That's why we see such a spread on the streets.
I would think that politically they'll move away from financial analysis. Yes, they'll look at any bank crisis that would happen or deposit flows and that, and far more to just a pure GDP analysis of 3% moving under 2%. And if you get under a 1% U.S. GDP dialogue, either present or guesstimates into the future, that's when you really get a change in dialogue.
Joining us now to talk about some of this, Alicia Levine, the head of investment strategy and equity advisory solutions at BNY Mellon Wealth Management. Alicia, wonderful to catch up with you. We miss you, and we wish you were here down in D.C. with us. She's up in New York this morning. Alicia, I want to start with a line from Bank of America and Michael Hartnett. Michael Hartnett put out a note, and he said investors are too optimistic on rate cuts and not pessimistic enough on recession. Do you agree with him?
So the equity market right now is in that betwixt and between place of incorporating both the chance of a mild recession and a soft landing. Because if you think about where the earnings spread could be in either of these scenarios this year, you know, on the recession side, you're down to about $190 a share for S&P earnings. And in the soft landing, you're at about $230. And right now, the market is trading kind of at that midway point, could go either way. So the market is agnostic right now on the recession, and I do think the market is clearly not pricing in a recession, but neither is it pricing in a soft landing, and it's pricing in a wait and see what happens. Unlike the bond market, of course, which is pricing in a pretty notable recession. The 2s, 10s, the 3-month, 10-year, it's all shouting recession. So the equity market's not pricing it in at all. And the thought that the Fed's going to cut 3 times by the end of the year, which is what the pricing of the curve is, presupposes a pretty notable slowdown that the Fed is forced to cut.
Alicia, it was before your time, but you have the courage to go back in history and look at the world according to GARP. What is GARP, and how do you drag it out of the ancient past into present choice of what to do in the equity markets?
Right. So, as advisors and as investors, we don't have the choice of avoiding the equity market. We go right into this. And GARP is growth at a reasonable price. And what that means is we don't want to be sector specific, but we do want to be in companies that have growth rates on the revenue line and can maintain their margins and therefore bring earnings to the bottom line. And you can find those companies throughout all 11 sectors, and that's how we are focused our investment theme right now, because the risk of being out of the market is that you miss the rallies, which ultimately grow out of this. In the end, nobody has a crystal ball, and while it looks like we're headed towards a recession, if we're not to be in the equity market will be a mistake.
But Alicia, Adam Tooze with us yesterday of Columbia, and he made real clear nominal GDP is a just analysis. Do we get a sprightly nominal GDP that colors or deceives that GARP strategy?
It doesn't, because nominal GDP feeds right into earnings. And so in the end, we don't talk about real earnings. We don't talk about earnings separate from inflation. We talk about nominal earnings, and this is how the market is priced, which is why it's not always the case that inflation is bad for the equity market, because it does get filtered through earnings, which are nominal. So GARP does not take that away. The issue is the margins. In the end, less focused on the revenue line, which will be flattered by inflation, and on the cost line and the margins, whether or not the costs are coming lower as inflation moves lower. If that happens, then you're set up for an equity market that can really rally into the half of the year. So it's all about what happens during earnings season and the margin line.
Well, let's talk about earnings. The arc of earnings season. The banks go first, Alicia. We'll hear from JP Morgan later this week. What are you expecting to hear from some of these major players in the financial sector?
Look, the big question is going to be on the outlook, and the question's going to be on funding going forward and the impact of any kind of regulation. I think in the end, the large banks and even the medium-sized banks have weathered the first quarter very well. Higher rates did flatter some of the earnings there. The question is, what does the new world look like when the FDIC and the Fed has guaranteed some deposits of the 2 banks that failed? What does that mean going forward on regulation, and how does that impact earnings? That's really the big question here. I think most investors, or at least analysts on Wall Street, have become experts on bank balance sheets at this point. It's a little bit of a joke, but true. And I think the issues are well known. So there's no secrets out there. It's not shrouded in mystery. The issue really is what happens with regulation going forward, which is an unknown.
Do you have to make the assumption now, can you make a conclusion, that it will be a less profitable world for these banks?
Well, I would expand that to the entire S&P, which is that earnings estimates have barely budged in the last 5 weeks since Silicon Valley Bank and Signature Bank failed, and I think that doesn't really pass the reality test here. So overall, earnings have to move lower. So it's in all the sectors, simply because the pressure of it is going to move lower. I think there are certain sectors, particularly in some of the cyclical sectors, that have really already had their bear market and the bringing down of earnings estimates quarter after quarter after quarter. And I think those actually, interestingly, are places to invest simply because they've already signaled either inventories were too high or they've cut estimates so many quarters in a row that you're starting from a very different place. So I'd expand that for the S&P.
Are you talking about retailers, Alicia?
I'm not talking about retailers. I'm talking, I mean, some of the semis, for instance, are really interesting because if you think about quarter after quarter, there's a reason they've rallied. They've rallied because they were down 50 to 70% last year on lower guidance and inventory gluts and slowdowns that were projected. Well, they've already had their bear market. They've already had their correction. And I think going forward, it's an interesting place.
Interesting. There's a call. Alicia, love catching up with you. You know that. Alicia Levine there of Win Mellon Wealth Management out of New York. Here in Washington, D.C., just want to pick up on some economic data we had a little bit earlier this morning. A survey from NFIB. It's the small business survey, closely followed in the United States. Tom, a net 9% of owners who borrow frequently said financing was harder to get compared to 3 months earlier. Yeah. That number, the most since December 2012, according to that survey from the National Federation of Independent Business, out a little bit earlier this morning.
This is the micro data. It's all coming out. It can be this, that, the other thing as well. And what's so important, is this a trend or is this a one-off? And I don't see anybody guesstimating it's a one-off. It's a trend in place, and you wonder where that trend will be 3 NFIB studies from now.
And to what extent, to what degree is that a substitute for more rate hikes from the Federal Reserve?
There's no question about that.
That's ultimately the call here, right?
No
That's ultimately the call.
Yeah, I strongly take that point, and I go to Dominic Constant, was way out front, was super restrictive, and he and Jerome Powell and you and me and the rest, we did not guesstimate that we would have a super restriction from banking dynamics, and yet that's the surprise we've had in February and March.
We usually step away from the studio in about 20 minutes time to prepare for the next program, Tom. I have to say I'll be glued to the TV and the radio as well through the office, because coming up at about 8:45 Eastern time, so about 30 minutes from now, Tom Keene one-on-one with John Bolton, the former National Security Advisor. TK, I'm looking forward to hearing you talk with John a little bit later.
Incredibly important interview and well-timed, with the silence in Washington over intelligence leakage.
From the nation's capital, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Pentagon says those leaked documents that detail U.S. spying on other countries is a risk to security. The papers include an assessment of weakness in Ukraine's military. The Pentagon is conducting damage assessment. Meanwhile, the Justice Department is trying to find out who leaked the documents. In North Korea, Kim Jong-un has called for what were described as practical and offensive war capabilities. That came as Pyongyang cut off communication links with South Korea used to reduce tensions on their border. This year, North Korea has tested new weapons and systems to deliver nuclear strikes against the U.S., South Korea, and Japan. In England, the state-run health service is bracing for its most disruptive strike yet. Tens of thousands of junior doctors walked off the job today for 96 hours. They're joining other public sector workers who are demanding bigger pay hikes to make up for inflation. The founder of blood testing startup Theranos has been ordered to report to prison this month as scheduled. A judge in California rejected Elizabeth Holmes' request to remain free on bail while she appeals her fraud conviction. Holmes was sentenced to more than 11 years in prison for deceiving investors. And billionaires Tyler and Cameron Winklevoss are using their own money to support their crypto exchange, Gemini Trust. Bloomberg's learned the twins have made a $100 million loan to Gemini. The firm has faced numerous setbacks during the year-long market downturn for digital assets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
You're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in Focus, Wednesday on Bloomberg.
Think about the dynamics over the last 6 to 12 months, complete shift in psychology, inflation still stubborn in a lot of countries. I think that's going to keep rates pretty well above pre-pandemic levels for a long time. So back to 2019 levels, not anytime soon, many, many years.
That's the call from Mike Schumacher, the global head of macro strategy at Wells Fargo, pushing back against the IMF view that once we've dealt with inflation, rates can go back to pre-pandemic levels. That's going to be a key feature of the conversation down in Washington as we approach the IMF meetings a little bit later this week on this program. I'm happy to say that Lisa's going to return tomorrow. Looking forward to catching up with Bramo. I can tell you now she's been working tremendously hard on this. She will be launching a surveillance newsletter a little bit later on this morning. You can sign up at bloomberg.com/newsletters. That's bloomberg.com/newsletters to pick up Bramo's daily musings on Bloomberg Surveillance.
What's
TK,
like
very
6
cool.
or 7 names on it? It was the working title 3 months ago was Toxic Brew, but
then the daily anxiety.
Yeah.
I like Toxic Brew. That's nice.
Well, yeah, you know, I mean, you got to pop on the internet and out on Twitter. You can see this out on Twitter. We're going to flog the hell out of it.
Very cool. Well, I'm looking forward to it. It begins today, and Lisa's going to be back on the program with us tomorrow morning. So we'll be covering the IMF World Bank meetings through the week down in D.C. with the full team.
Right now, on the bond report, Ian Lingen joins us, head of U.S. Rate Strategy, BMO Capital Markets. And Ian, you know, I was getting a brief this morning from my senior executive qualified producer, Qantas, and Qantas said, Tom, you got to look at the BTMM Go screen on the Bloomberg. You look at it all day, Ian. What are you seeing in the 3-month and in paper right now? What is the indication from 1 month, 2 months, 3 months, dare I say 6-month yield?
Well, right now at the moment, Tom, what we see is that the most high-yielding aspect of the Treasury market is in the very front end of the curve, and what bill rates are responding to are two things. First, we have a monetary policy maker in the form of the Fed who's willing to get us to terminal and hold terminal for an extended period, so that's going to impact the 3-month bill. That's going to impact the 6-month bill. But perhaps more importantly, there's a fair amount of uncertainty at the moment as it relates to the debt ceiling and the potential for dislocations in certain bills if they fall into the window where the Treasury Department risks missing a payment.
Ian, I look at the 3-month as compared to 10-year yield, the 3-month, 10-year spread, and I'm not allowed to do standard deviation studies in Washington. It's un-American. But if I did, the inversion of that curve back 20, 30 years is 4, 5, 6, dare I say 7 standard deviations, massively inverted. What does that signal?
Well, historically, the Fed has looked at the 3-month bill versus 10-year curve as an indication of the probability of a recession within the next 12 months. So at the moment, it suggests that we are at a high probability of a recession in the year ahead. What I think is more fascinating is that market participants are very interested in attempting to extract the severity of the inversion and map that against how large of a recession we might or might not see. I think that's one of the key uncertainties, if for no other reason, because embedded within this is the idea that the Fed is going to be effective in containing inflation expectations going forward, and that should compress break-evens. And I think that's one of the key reasons the curve is so inverted.
When the curve is inverted like this, Ian, particularly at the front end in the way you describe, does that impede maturity transformation? And perhaps I'll put that in a more simple way. Does that prevent banks from lending to the economy in the way they traditionally would?
I think that in a traditional environment, a steep yield curve is the best case scenario for banks because they can borrow at comparatively low rates and lend at higher rates. Fast forward to today, however, and we're in a unique environment where financial assets more broadly are responding to any drop in rates. So as we can see, risk assets do well, stocks in particular, when either realized yields decline or forward expectations for policy rates shift lower. So we're in an environment where the traditional might not necessarily hold. We are in the mode of bad news being good for risk assets, which really does complicate the Fed's outlook for the next several months.
So, Ian, if we take the whole curve, as Tom pointed out, from T-bills all the way out to, say, the 10-year, let's cut off bills and just look at, say, the 2-year note out. What we've seen there is a bull steepener. The re-steepening of the curve, taking away some of that inversion over the last month, Ian. That's because we're pricing in a lot of rate cuts, and you alluded to that. Ian, I just wonder in your mind whether that move has gone a little bit too far, too quickly, based on what you expect from the Federal Reserve later this year.
I think that the outcome between now and the end of the year is particularly binary. And by that I mean we're either going to end the year with effective Fed funds at 5.1%, as the Fed has already suggested via the SEP, or things are going to go bad enough that the Fed is going to need to cut 150 or 200 basis points to offset any slowdown in the real economy or increase in the unemployment rate.
Ian, there's such respect for the persistency, the quality of your work. I want you to speak to the younger Turks of fixed income who are getting used to an environment we knew decades ago. What is the number one pro tip you have for people who went from negative real yields, negative rates, out to where we were, hearkening back to another time? What's your number one pro tip?
That's a great question, and I appreciate the kind words. I would say if I could impart one piece of wisdom, it would be that U.S. rates are impossible to model in the traditional way because what impacts the overall risk-free rate is constantly changing, whether it ends up being a traditional impact such as inflation or geopolitical concerns or political concerns in Washington as it relates to the debt ceiling. The primary influence is always moving, and so stay connected with what's going on and make sure that you're dynamic in your thinking about how to predict rates going forward.
Ian, what you said 60 seconds ago was amazing, that this is binary, that this is basically going to mean the Fed is at 5.1 year end, or they have to cut between 100 to 150 basis points. Neil Dutter of Renmac said the same thing in the last couple of weeks. He said there's no in-between in a banking crisis. Either they're not going to cut, or you haven't priced in enough cuts at all, even with this move that we've priced over the last month. Now, Ian, when you say that to clients, that must drive them nuts. You can say on the one hand, we might end up at 5. On the other hand, we might end up 150 basis points lower. Ian, what do they say back to you?
Well, one of the key aspects of our outlook for this year is we do see, regardless of what the Fed ends up doing, that 10-year yields in the year at 3%. So one of two things occurs. One is things go bad enough in the real economy that the Fed is forced to cut and cut more dramatically, or the Fed is successful in reestablishing price stability, which further compresses break-evens, and all else being equal, for the same real rate, if break-evens are declining, you can easily get nominal 10-year yields to trade with a 2-handle. And that message has been remarkably well received.
Wow, Ian, that's amazing. That is quite cool. Ian Lingham there of BMO Capital Markets. Ian out of New York. What a call. So basically it goes bad and they have to cut, and the 10-year goes to 3, maybe a 2-handle, or it goes well and they get the disinflationary trends they want, and a 10-year still has to go down to 3, or maybe even a 2-handle.
When we invented this, and John, as you and I have advanced this forward, will you just, if you're not part of global Wall Street, bottle that. You just heard from a guy, his wisdom for those younger, the binary thing you were talking about, John, and he sums it up with a Steve Major HSBC yield outcome that no one on the planet believes except Kristalina Georgieva.
I'd throw in Bob Michael at JP Morgan Asset Management too. He thinks 3.00 on a 10-year. And to be fair, we're only 40 basis points away on a 10-year yield at the moment.
I take your point of 40 basis points or even to get to a shocking 295, but people aren't modeling it. They're modeling out a toxic brew. Price down, yield up. This could be in the newsletter today.
I look forward to that. I imagine it will be. Next hour on Bloomberg TV, Matt Hornback of Morgan Stanley, Emily Rowland of JH Investments, Tony Rodriguez of Nuveen will advance this conversation forward. From Washington, this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg Surveillance. Good morning, everyone, on radio and television from our studios in Washington. Tom Keene, as we begin 4 days of coverage of international economics. Yes, still focusing on the markets. That inflation report tomorrow. What I want to say about the data is real simple. There's a churn to the market. We had green on the screen earlier, ebbed away a little bit, and we come back ever so slightly. maybe possibly equities, bonds, currencies, and indeed commodities waiting for that inflation report tomorrow. I would note American oil, West Texas Intermediate, under $80 a barrel. What a joy yesterday to greet Adam Tooze, of course, adding so much to this discussion of economics, and all of it, including my panel on Friday with Gita Gopinath, center around the outlook for what an appropriate growth rate is. We advance that conversation now with Michael Darda, Chief Economist and Market Strategist, Roth MKM Partners. Michael, it's such a rich discussion right now, and the polarity of this around R-starred, and I want to stay away from the arcane, is the guesstimate of an appropriate run rate for an economy of higher or lower post-pandemic. You side in that we will see subdued R-starred and a surprisingly slower all-in-all economy. How do we get there?
Well, Tom, I think you could just ask the question whether the underlying fundamental drivers of the supply side of the economy have picked up dramatically. And if we look at the trends in non-farm productivity, it really doesn't look like there's been much of a pickup. In fact, the numbers are actually quite a bit weaker than the average of the last business cycle. And we know that in terms of working age population growth and demographics, those things don't just change on a dime. So it doesn't look like there's some kind of big structural shift. What defines this business cycle and differentiates it from the last is the explosive average growth rate of nominal spending in the double digits on average. But we think that is going to come to an end in very short order now that the Fed has tightened policy so abruptly, and we have this backdrop of a contraction in money and credit. So looking forward, these nominal GDP figures, I think, are going to end up sinking below the average of the trend of the last business cycle. And with that, inflation will come down a lot as well.
Well, just let me get the market call out of the way. What does the 10-year yield do in that environment? We've heard from a number of people today shocking us with a 3.0 or even a 2% handle on the 10-year yield. Do you suggest we fall below 3%?
I think we could, Tom. In fact, I think it was on this show last September where we came out and announced a bullish view across the Treasury curve. So that turned out to be a little bit early, but the call is working. I think, by the end of the year, 2.75%, 3% on the 10-year is very much doable. But that's in the context of the U.S. economy likely falling into a recession. And with recession, you get lower inflation, a lower equilibrium interest rate, and Fed rate cuts.
One of your great mentors was Jude Wanniski, the late, great Jude Wanniski, and he had the courage to have a vision out 60 months. So does the International Monetary Fund, and they shocked us a number of days ago in conversation with Dr. Georgieva of a shocking 5-year 3% global GDP. Does America participate in that, or can there be American exceptionalism where we do better?
Well, Tom, we could do better if productivity growth picks up. But as we just discussed, not a lot of evidence of that at the moment. Perhaps some things could be done on the supply side to try to boost innovation and efficiency. But it's really hard to see a dramatic shift afoot. Perhaps some innovation comes along that, that really boosts the capacity side of the economy. But I think, the numbers that we were seeing in the last business cycle are probably fairly close to what we would look for in a steady state equilibrium. Right. If productivity growth is, 1.5 or so, labor force growth is going to be 0.5 percentage point. So 2% real, and then with a 2% inflation target over time, nominal growth around 4%. I think, that's the most reasonable. We could talk about outliers and upside or downside surprises, but in terms of a base case scenario, I think that's what we're looking at. And so the current rate levels, I think, make sense in that context, although in a recession scenario, you end up going lower. And I think, unfortunately, that's probably where we're headed.
Within the continuum of 4, 5, 6, even 7 front rate economists, leading people who frame out from a 2% Fed guidance out much, much higher, I want to focus on the former vice chairman of the Federal Reserve System, Richard Clarida of Columbia, who in The Economist this week, Michael, laid out as a former Fed official an ability to get back to above 2%. Institutionally, how will the Fed react if we get a Clarida above 2% trend rate on yield and on policy?
Well, look, Tom, if it's coming from the supply side, if it's coming from efficiency gains, productivity gains, then that's completely consistent with the Fed hitting its inflation target over time. In fact, a positive supply side shock will lift real magnitudes, real growth rates, and lower inflation rates, all other things equal. Okay, so if that's what we're talking about, that's completely consistent with the Fed's goals. If we're talking about demand side stimulus, that's a different story. That's under the Fed's control, and they have to bring nominal spending down in order to control inflation and get back to target. So I think if we're going to get a faster trend growth rate because of enhanced efficiency, then yeah, for sure, that's the gift that keeps on giving. We'll see if we can do that.
Frame 12 months forward, nominal GDP and real GDP. I think our market economist crew would like to know what you think on that. Where is nominal 12 months out year over year and also inflation adjusted?
Tom, I think we're going to tumble pretty hard moving into mid-year and in late 2023. So if we look at some of the leading barometers of nominal spending, I mentioned before that we have a contraction in the banking system. So in just 2 weeks, we saw commercial bank credit collapse by more than $300 billion. Commercial bank deposits are down almost $1 trillion over the course of just over a year. And you've got the Fed that has its policy rate above every note and bond yield across the Treasury yield curve. So that is not a configuration that should lead us into thinking that there's going to be some kind of perfect soft landing or no landing scenario. I think the landing could be quite a bit harder than many are discussing. And in that context, you could have nominal GDP fall to zero, even below zero temporarily. And that is a recession scenario. It won't be a permanent state of affairs. Eventually, the Fed will have to adjust. But I'm afraid they're being dragged along by lagging indicators of the business cycle. Service sector inflation is in the index of lagging economic indicators. Payroll growth, it's critical, but it's a coincident indicator. The forward-looking data is pointing down at the moment. And we just got the NFIB data for March. If you look at the underlying index on small business credit conditions, availability of loans, we're at levels now that you do not see outside of recessions.
Right. John, what's so important here, John Farrell mentioning NFIB earlier. Michael Darda, let's go to University of Wisconsin textbooks, which tell me, given the Darda scenario, you're going to get stabilizers to come in. Do we have the fiscal space, and other attributes that can stabilize the economy, given your cautious view?
Tom, I don't think there's any scope whatsoever for demand-side fiscal stimulus. That makes absolutely no sense when the Fed has policy rates up close to 5%. So there's tremendous scope for the Fed to reduce the policy rate if that is appropriate and that is required. And obviously, there are other things the Fed can do to ease monetary policy and to boost aggregate demand when the time comes. They still want to be sure that inflation is moving lower in a sustained fashion. So that is not on the table just yet, but let's see where we are in a few quarters. But in terms of fiscal policy maneuvering from the demand side, I think that's out of the question. What fiscal policy should be focused on now is the supply side. The previous discussion that we had about trying to enhance incentives for growth and economic efficiency, but demand side Keynesian fiscal stimulus, game over. That is finished.
I knew I was going to get
forward.
I knew I was going to get this answer, folks. I just want to get Michael Darda riled up. He usually gets up at 10 a.m., so I just want to get him riled up here this morning. How big a mistake is a rate rise May 3rd? I mean, I'm not going to fault the Fed if they're data dependent and they got to wait for obvious data that, they're not in the game you're in, Michael. But is it a mistake to see a May 3rd rate increase?
I think it is, Tom, and I think the last hike was also an error on the part of the Fed. And data dependency is fine as long as you're not dependent on the wrong data. But if you're looking in the rearview mirror, then you're going to be igniting boom and bust cycles. And I'm afraid we're moving into the bust part of the cycle. So the March data has been much softer than what we were seeing in January and in parts of February. And so that's telling us that the economy is slowing down. In the background, we do have this banking crisis that's ongoing with a contraction in money and credit. So to have the Fed adding on now, continuing to push short-term interest rates up and to push the curve into deeper inversion, I think sets us up for a potentially deeper downturn than would otherwise be the case.
Is a general statement, is Phillips curve analysis dead? For those of you not part of Global Wall Street, this is LSE economics from, I'm going to guesstimate, 1953, when George Soros was darkening the door at LSE a few years ago. Is the continuum of inflation dynamics with rate dynamics, inflation dynamics, is that a dead study, Michael Darda?
I think so. I mean, it obviously got the Fed into a lot of trouble earlier in the business cycle when it just assumed that we could rapidly reapproach the previous levels of the unemployment rate with no inflation. So it was certainly, a big failure in this business cycle and in past cycles. But monetarism is back on the ascent, Tom. You may have seen the article
here we go.
in Bloomberg today. But, the shocks that we've been dealing with were foreshadowed by a huge explosion in money supply figures, which have now turned down. And so I think we need to reorient policymakers into a more monetarist fashion and more forward-looking. And I think that would help a lot to eliminate some of these boom-to-bust cycles. But the Phillips curve is just not going to work as an intellectual policy apparatus.
Michael Darda, thank you so much. Hugely controversial. He is with Roth, MKM, and oftentimes right on the linkages into the market. It is our Washington conversation of the day. Coming up, the former National Security Advisor, John Bolton, on all that digital intelligence leaking out across the world. This is Bloomberg Surveillance from Washington.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden will head to Ireland today for a long-awaited return to his ancestral home. His first stop is Belfast, Northern Ireland, where he'll meet with UK Prime Minister Rishi Sunak. He'll then travel to the Republic of Ireland to mark the 25th anniversary of the Good Friday Agreement and celebrate the recent Brexit deal. In China, the government plans to require a security review of ChatGPT-like bots. Providers of the generative artificial intelligence services must ensure content is accurate and neither discriminates nor endangers security. That casts uncertainty over AI bots unveiled by China's largest tech companies. Russia will expand the penalties for draft evaders. That's aimed at fixing the problems exposed in last year's mobilization of 300,000 reservists to fight in Ukraine. Under the new plan, draft evaders would be banned from leaving the country, getting driver's licenses, buying and selling property, and taking loans. A setback for Moderna. The biotech company says a final stage study of its first experimental flu shot hasn't accumulated enough data to determine how well it works. So now Moderna will start a study of an updated version. A flu shot is crucial to the company's future. Its COVID vaccine sales are expected to drop off. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The president has been briefed. He was first briefed late last week when we all got word that there were some documents out there. We don't know who's behind this. We don't know what the motive is.
At this point, do you believe the leak is contained? Are there more documents out there that have not been released? Complete? Is this an ongoing threat?
We don't. I truly don't.
One of my favorite people, White House National Security Council spokesman John Kirby, he with legit military experience in the United States Navy, talking there about, as you have heard over the coming days, and particularly this morning, recent military intelligence leaks. Unfortunately, we have to do an audible with John Bolton, former National Security Advisor to President Trump, Ambassador to the United Nations under George W. Bush. And for those of you on radio, Bolton appears today with arm in sling, no doubt one of the people going after Bolton. What'd you do to the other guy, Ambassador? Did you hit him hard?
It was pretty grim, I have to say.
I'm sure it was some Bolton drama there. Let's get to the drama of the moment. And I want to begin with a Wall Street Journal reporter jailed in Russia. You have been inflammatory and said, throw the bums out. You want the ambassador of Russia to be removed from the soil of the United States of America. Discuss that.
Well, look, this is obviously an entirely political decision by the Kremlin. They're taking this reporter hostage. They're accusing him of espionage. We know that's not true because it's been a long, long time since we've used reporters for that purpose in order to protect them from exactly this kind of thing. Clearly, the Russians want to exchange the reporter for something. We don't know what yet, but I think instead of pleading with him to let this hostage go, and he is a hostage in effect, I think we've got to declare the Russian ambassador persona non grata. I think we ought to go to our NATO allies and ask them to do the same, because it could have happened to any one of their journalists. A strong response is the only thing the Russians understand, and if we don't start now, Gershkovich could be in jail for a long time.
Ambassador Bolton, I want to continue this discussion, but because of time and such an ample news flow, we've got to move on. John Bolton, we have an intelligence leak. This is not Matt Damon, and I know Matt Damon was going to play the part of you in another movie. It's not The Bourne Identity. It's not paper under park benches and that. This is your world being affected by digital technology, digital media. Do we need to radically change our intelligence distribution because of new technology?
Well, I think there's a lot we can do to safeguard classified material better. And I would certainly say, based on what we know publicly, the presumption at this moment is this is some kind of leak out of the Pentagon or other U.S. sources. And we don't know whether we're at the end of it or not. It could be more. However, I would also caution at this point that we not draw too many conclusions. This could be an influence operation by somebody, we don't know who. And once you get into the world of counterintelligence, it makes being in a hall of mirrors look easy. It's very complicated, and depending on how sophisticated the actor might be, really can wrench your mind around. So we've seen some anomalies in what's been reported. Just this morning in South Korea time, the government there said that the information that looked to be leaked about their consideration of selling artillery shells to Ukraine was false. So we don't know whether that's disinformation too. But all I'm saying is, while I don't have any basis on which to contest what seems to be the case, that this is a U.S. leak and therefore a huge U.S. problem, I just think we need to be very careful before we jump to too many conclusions.
I look at this, Ambassador, and I'm doing audible here, and it's just a general question for the American public, not Republican, not Democrat. In your experience, how removed is the intelligence community's process and day-to-day grind from the way it's perceived by Hollywood? Is Hollywood accurate, or are they just off the mark on a movie-by-movie basis?
Well, the Hollywood movies are very exciting, and some of that does occur, but you know, we collect huge amounts of intelligence through what we call euphemistically national technical means, meaning electronic and other forms of surveillance. Frankly, we need a lot more human intelligence collection than we have, and we need a greater clandestine operations capability than we have. I think Puritans in the foreign policy establishment have looked down on clandestine operations for a long time. We're in a very dangerous world. We could use a lot more. But it's something I think Americans, if they really knew what our intelligence collection capabilities were, would be very proud of what we're able to do.
John Bolton, I want to move to the bipartisan thrust of Washington against China. Should we be cautious because there's such a fixed bipartisan nature to our anger over China? Do we overreact?
Well, I don't think we've overreacted yet. I agree with you that there's certainly an unusual character to the bipartisan nature of the China is essentially an existential threat to us and the West as a whole in this century. And their challenge is really across the board. It's not just political and military, although it's very much in those sectors. It's economic as well. Decades of stealing our intellectual property, discriminating against foreign investors and traders, manipulating the international financial system to its advantage. There's a lot that's gone on for a long time. We're just really beginning to appreciate and catch up to. So I think the bipartisan concern here is warranted.
Among others, he's talked to James Stavridis, of course, the former admiral, about a Pacific Rim build-out. I know that the United States has a new dialogue with the Philippines, among others. Does Bolton suggest that we need to rebuild out our military in the Pacific Rim, not just for Taiwan, but also for the South China Sea?
I think we need to rebuild it across the board. I think the next American president needs defense budget increases in the range of what Ronald Reagan did during his presidency, maybe even more. I think that implies even greater cuts to domestic spending to get our deficit down. But let's be clear, we've been asleep at the switch for a long time here. Going back to the end of the Cold War, people said it was the end of history. We had a peace dividend. We've got to put all that behind us. We face a very wide range of threats. Let's just take the Pacific. Get a map out that has the Pacific Ocean in the middle of it. It's a long way away. We need probably 50 more naval war vessels in our fleet just to deal with the Pacific, let alone increases for the rest of the world.
John Bolton, what's so important here is those of us of a certain vintage remember our intelligence misestimates of the Soviet Union. Do you have a confidence in our intelligence of China, or do we make the same misguiding that we did with the Soviet Union? Do we know what we're talking about with Beijing?
Well, I think we've got pretty good estimates on key areas. Some of it's visible to us already. Their capabilities for offensive cyber operations, for example, the military buildup that they've undertaken in anti-access area denial weapons to push us back from the western shores of the Pacific, their anti-satellite weapons capabilities to blind our eyes in the sky in time of crisis or conflict. That evidence is out there, as is the evidence of things like weaponizing what otherwise look like commercial companies, Huawei, ZTE. They're not telecommunications firms. They're arms of the Chinese state trying to take control of fifth-generation telecommunications.
John Bolton, thank you for joining Bloomberg Surveillance this morning. Former Ambassador Bolton, of course, has worked with the National Security Council as well, always controversial. This has been a superb first day for us in Washington. Lisa Abramowitz joining us tomorrow. As John mentioned earlier, we're so thrilled to bring you, as a kickoff to these spring meetings, something Lisa's really going to be working on, which is a Bloomberg surveillance newsletter. We're just thrilled about this project, the depth of it. I'm going to be honest, it's a working project. Lisa's making it up as she goes with our editorial team. So look for the surveillance, the newsletter. John and I are working on a name. We've really weighed in with surveillance. Toxic Brew. We'll see if that comes to fruition or not. We continue forward, and coming up here in the coming days, we will speak, of course, much more of these spring meetings of the International Monetary Fund and the World Bank. Front and center for us is the shocking call of economic slowdown for the IMF over 5 years. But we'll wrap that into everything forward of the market data, and that begins strong tomorrow at 8:30 with the inflation report. We'll look at that front and center tomorrow. 10:30 this morning, Bloomberg Markets. The chief economist for the International Monetary Fund, Pierre-Olivier Garnichat. Look for that coming up here. From Washington, all this week, this is Bloomberg Surveillance.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Live from Washington, D.C. for our audience worldwide, I'm Jonathan Ferro. Good morning to you all. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from Washington, coming up, one top Fed official shakes off criticism of hiking too fast. Citigroup economists say banking stress looks to be contained as the IMF says rates could head back to pre-pandemic levels. Let's get straight to the conversation with Matt Hornback of Morgan Stanley, Emily Rowland of John Hancock Investment Management. Emily, first to you. This idea from the IMF, and I'll get to their outlook in just a moment, that we can go back to pre-pandemic levels on rates. Emily, when you read that yesterday, what did you think?
I think it's telling us something that could actually come to fruition here. I mean, you look at what typically happens during these cycles is the Fed hikes until something breaks and then they cut meaningfully, and central banks globally do that. In fact, we've seen the Fed funds rate come down an average of 4% over the last 4 cycles. So that brings us all the way back down to 1% on the Fed funds rate. We think that longer dated treasuries follow suit. We think accordingly, this is a great opportunity to be invested in high quality bonds.
Matt Hornback, do you share that view?
Well, certainly directionally, yes, we share that view. We think that the bond market is very attractive here for investors. We see a lot of value both in owning short-dated bonds and long-dated bonds. We do think that the yield curve is going to steepen, John, but yeah, we think that yields are headed lower for now.
Looking at the views of Citigroup, compare that and contrast it to the views from Apollo and Torsten Slok. Andrew Honhorst and the team saying the worst of the banking fallout is done. They said this: the banking stress increasingly looks to have been contained. Just compare that to what we've heard from Torsten Slok of Apollo in the last week, who said quite simply, the credit crunch has started. Is it one or the other for you, Emily? When you really think about it, it's either the credit crunch has started or you think this is contained. Which one is it?
Well, the issues that we've had so far with some of the regional banks seem to be isolated, but there still could be further issues that are kind of coming to fruition as this lagged impact of Fed tightening causes these solvency issues to come to the forefront. You know, there's a famous Warren Buffett phrase that a lot of people have referenced, that when the tide goes out, we're left to see who's swimming naked. And I think that there's still probably a few characters out there that are swimming naked that are left to be still going to be uncovered here. So we want to be really, really mindful of that. We want to stay away from those companies that are over levered, that have binged on cheap debt, and we want to be emphasizing quality and defense in this type of macro environment.
Matt, do you think the banking stress is contained, or do you think the credit crunch has started?
Well, look, if you look at some of the recent data, both from the Federal Reserve, but also this morning, John, where we got data from the NFIB on small businesses, you can see very clearly that this is not yet over. Small businesses are reporting that the availability of loans is declining pretty meaningfully over the past month. And so that's a pretty telltale sign that this is not yet over. We think it's much too soon to suggest that this is behind us, John.
Just getting a cut from the IMF in their World Economic Outlook, cutting the 23 world GDP growth outlook to 2.8%. This is a trim, if you want to call it that, from 2.9% in January. So the 2023 outlook from the International Monetary Fund for global growth cut to 2.8% from 2.9% back in January. That's the outlook for global growth. Let's get to Mike McKee for a little bit more on this Federal Reserve. Mike McKee, I have to say, very interesting to hear the comments from John Williams of the New York Fed in the last 24 hours. What stood out for you?
Well, he's giving the same sort of guidance that his co-workers at the Fed have been giving, that he doesn't think we're going to see rate increases continue at the same pace, but he also thinks it's not the case that they caused the problems at the banks. Tomorrow we'll get evidence on that, whether or not the problems at the banks are leading to any kind of price problems and what that means for the pace of rate increases ahead, with the CPI halving its rate of increase, but the core barely budging, and it looks like the core on a year-over-year basis, according to economists we spoke to, is actually going to rise. So does this mean the end of Fed tightening after the May meeting? This report probably not going to tell us. The other issue out there, of course, is the credit outlook. And we did see a tightening of credit standards after the bank issues. But does that continue? The senior loan officers survey won't be out until after the Fed meeting, so we don't really know at this point. But as you can see, banks tighten what they call moderately in times of recession, and we saw a big rise already in February, so does it go higher? Do we get tighter? We have not seen a real impact yet in consumer lending. Here's John Williams on that issue. He says we really don't know whether this will happen this time. We haven't seen any clear signs yet of credit conditions tightening, and we don't know how big those effects will be. But Wall Street still worried. They're still pricing in 3 cuts for the rest of the year. And Bloomberg Economics is out this morning with a prediction that we're going to see a recession in the second half of the year. Growth may be slightly positive for 2023 as a whole, but past Fed tightening and depletion of households' excess savings should tip the economy into an investment-led downturn starting in the third quarter. That's Anna Wong and Elizabeth Winger. So the debate between the markets and the Fed continues, John.
And will likely continue for many months from now. Mike, you touched on that work, those comments from John Williams of the New York Fed. He also said this: I personally don't think that it was the case that the pace of rate increases was really behind the issues of the 2 banks back in March. Mike, I know you've talked about this already, particularly over this morning and over the last day. Can you tell me how you think about those comments? The Fed has taken some criticism for moving too quickly from 0 towards 5, and some people have pointed the finger at them for the banking failures we've seen in the last month or so.
Well, here's what Williams is trying to say. The Fed moved very aggressively to raise interest rates, but they only raised interest rates at the short end. The long end went up because Wall Street was worried about inflation, and it's the long end securities that are the problems for these banks. So if the Fed hadn't acted, inflation expectations probably would have pushed long end rates down even further, and that would have been a real problem for the banks, a much bigger problem for the banks than had the Fed not moved as fast as it did.
Mike McKee on the latest comments from the Federal Reserve. No doubt we'll get more of them through the week. I keep returning back to the Canada CPI coming up tomorrow. Mike McKee's going to break that down for you tomorrow morning, 8:30 Eastern time. Then after that, of course, we get the bank earnings a little bit later on in the week. JP Morgan bank earnings kicking off a little bit later in the week on Friday. This line from John Williams of the New York Fed: I don't worry too much about market expectations well off into the future. Time will tell. Matt Hornback, the spread between the market right now priced for cuts later this year and the Fed projecting interest rates to stay above 5 through the remainder of the year once they've hiked once more perhaps, do you think that spread is something that should be of concern to this Federal Reserve? Or do you take the same line that John Williams takes, that you don't pay too much attention to it, it doesn't really matter, time will tell?
Well, I think what it tells the Fed and what it tells investors in general is that the risks are significant and they are skewed to the downside for economic activity. I'll take issue with a lot of the things that President Williams said in those comments, especially those that were highlighted by Mike McKee. I don't understand this idea at all that because the Fed raised interest rates at the short end of the curve, that wouldn't have an impact on longer-term interest rates. In fact, as the Fed was raising short-term interest rates, John, inflation break-evens were coming down. So I don't quite understand that line of reasoning. It's very clear to any market observer that the Fed moving very quickly, raising interest rates, injected a lot of term premium into the bond market, which almost certainly pushed longer-term yields higher. So, gosh, there's a lot to unpack there, but it's just confusing to listen to those comments.
Emily, can you unpack some of that as well?
I mean, I think it comes down to the basics. There's nothing like a deeply inverted yield curve to tell you that you're making a mistake. And that's exactly what's happening here. The bond market is all over the place. You look at the 2-year Treasury yield, it was above 5, below 4. When the 2-year Treasury yield is acting like a meme stock, there's a lot of uncertainty here around Fed policy. And so I think that lack of clarity is is going to continue here. One more hike in May and then 3 25 basis point rate cuts over the rest of the year is what the bond market is pricing in. The Fed says they're not going to cut until 2025. The Fed is not going to tell you that they're making a mistake, but that's what it looks like to us.
You mentioned a 2-year acting like a meme stock. I think, Emily, I've said it's trading like a penny stock. It's been wild. Last week, the lows were in the 360s. The high was north of 4%. Emily, we dropped to the 360s last week because we had a string of weaker than expected economic data out of the United States. Then on Friday, we concluded the week with something better than expected. I just wonder where the noise is and where the signal is for you. It's a question I've asked over the last 24 hours. Can you help us answer that?
Sure, yeah. It's a late cycle environment, which is the trickiest part of the cycle. The economic data are all over the place. And then, of course, we get that jobs report on Friday, and the U.S. labor market is made of Teflon. We're seeing that continue to be the bright spot of the economy, but we are seeing some cracks. Challenger layoffs are up 300% year over year in March. Job openings are at the lowest level in over 2 years, still above pre-pandemic levels. So the labor market's okay, but initial claims are starting to inch up here. So we do think that the lagged impact of Fed tightening will impact the labor market, which is really, really critical here. The problem is the labor market is the last shoe to drop in the cycle. So we've got to see earnings come under pressure before companies really act to protect those margins by doing layoffs. And then we need to see those layoffs translate into the unemployment data. That goes up, and then the Fed can cut, and we can start the new cycle. We're just not there yet. We are stuck treading water in the never-ending late cycle period right now. It's a really tough one and a confusing one for investors.
Yeah, it's been 12 months of upside surprises on the payrolls report. Matt Hornback, when you look at the totality of the data, just to borrow that phrase from the Federal Reserve, where's the noise and where's the signal currently?
Well, John, the way that I look at the labor market is relative to the income that it's generating for people that are actually working. And what we're seeing in the labor market data is that income that's being generated by the labor market is slowing. The January numbers were clearly a one-off, affected by weather and seasonal factors, but the trend is very clear. Income that's being produced by the labor market is slowing, and that is what is most important here, John. If income is slowing, spending will slow. As spending slows, the economy will start to slow down, and that's what's happening. So that's what we see when we look at the labor market, and we expect that trend will continue as we make our way through the end of the year.
We'll continue this conversation. Matt Hornback, Emily Rowland sticking with us. Just to recap some of the headlines we had about 10 minutes ago from the International Monetary Fund, out with their World Economic Outlook, trimming their outlook for global GDP to 2.8% from 2.9% just several months ago, saying the risks to the world growth outlook are weighted to the downside, so downside risk to that outlook from the IMF. Some more comments on that a little bit later. Earlier on this morning, we had some interesting data here stateside from the NFIB, from the National Federation of Independent Business, out a little bit early this morning. Take a listen to this line here. A net 9% of owners who borrow frequently said financing was harder to get compared to 3 months earlier. That number, that net 9%, the most since December 2012. Just something to think about as we think about the shock of the last month and how it's going to bleed through the U.S. economy. I'll return to that topic through the hour. As I say, equity futures this morning, muted price action going into the opening bell. Really the firework kind of stuff kicks off tomorrow when we get CPI on Wednesday, and then forward to the week for the rest of the week when we get bank earnings too. Let's get you some movers going into the open. Here's Katie Greifeld. Hey, Katie.
Hey, John. Well, let's kick off with CarMax because shares are surging this morning, up about 6% pre-market after reporting an adjusted EPS of 44 cents. The average analyst estimate was for just 20 cents, so a big beat there. You can see that in the shares. Moving on, big news in the gold mining industry. U.S. gold giant Newmont has put forward a new $19.5 billion bid to buy Australian rival Newcrest. Now, if completed, this would be the largest gold mining takeover ever, but you can see that price tag has Newmont under pressure this morning. Also under pressure, of course, is Moderna. The company said that a final stage study of its experimental flu shot hasn't accumulated enough data to determine efficacy. As a result, Moderna plans to advance a different candidate, but you can see shares off more than 4% before the bell.
Hey, Katie, thanks for that. Coming up on this program, the IMF seeing rates returning to ultra-low levels.
Inflation's still stubborn in a lot of countries. That's going to keep rates pretty well above pre-pandemic levels for a long time.
That conversation up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When you think about the dynamics over the last 6 to 12 months, complete shift in psychology, inflation still stubborn in a lot of countries, I think that's going to keep rates pretty well above pre-pandemic levels for a long time. So back to 2019 levels, not anytime soon, many, many years.
The IMF expecting interest rates to revert back to pre-pandemic levels, writing in its latest World Economic Outlook, quote, the effective lower bound on interest rates may become binding again. This as the IMF cuts its 23 global GDP growth forecast down to 2.8% from 2.9% only back in January. Bloomberg's Katie Lyons taking a deeper look at this one in D.C. Hey, Katie.
Hey, John. Well, in theory, maybe rates have to go lower as the chances of a hard landing for advanced economies, the IMF says, has increased, due in part to questions around financial stability here in the U.S. As you just said, 2.8% is now the growth outlook for this year. Yes, that is down 0.1% from the level seen in January, but it's down a full percentage point from what the IMF believed in January of 2022. That is how far this growth forecast has fallen. When it comes to inflation forecast higher than expected, 7% in 2023. That is 0.4% higher than in January. Just a word, though, on the accuracy tendency of these forecasts. The IMF is only within 0.1 percentage point of accuracy about 6% of the time in data that Bloomberg looked back, going back to 1999. The other 94% of the time, they either over or underestimate growth by a larger amount than that. So we have to keep that in mind, especially as the IMF talks about how there is more uncertainty clouding the forecast this time around. To quote it directly, they say the recent increase in financial market volatility and multiple indicators pointing in different directions. The fog around the world economic outlook has thickened. Uncertainty is high and the balance of risk has shifted to the downside so long as the financial sector remains unsettled. This is where we turn our eyes to Janet Yellen, the U.S. Treasury Secretary, later this morning. John, she's speaking at 11 a.m. Eastern time. How does she address concern around financial stability? If I had to guess, I would think she's going to say the banking system here is sound and resilient.
Bit of tension there. Kayleigh, thank you for that. And that's what we've heard repeatedly from the Treasury Secretary over the last month or so, the last 30 days. I want to pick up on that quote from the IMF in the last 24 hours on pre-pandemic levels of interest rates. This is what they had to say. Recent increases in real interest rates are likely to be temporary. When inflation is brought back under control, advanced economies' central banks are likely to ease monetary policy and bring real interest rates back towards pre-pandemic levels. Now, Matt Hornberg, I know the conversation has shifted somewhat. Over the last 6 months, all we've talked about is how far they'll hike. Now we're having a conversation about how far they'll cut back when they do start cutting interest rates. Does any of that, Matt, and I know we touched on this about 15, 20 minutes ago, does any of that resonate with you? This idea that we're going to return to pre-pandemic interest rates?
John, it's a tough one. I would say, again, directionally, I think the IMF there is right. Interest rates are moving lower. But it's hard to call the magnitude. That's the reality of it. You know, what we're telling our investors is that, you know, real rates at these levels that we see today in the marketplace are attractive. Whether they go all the way back to the levels that existed before the pandemic, really kind of in the post-GFC world where the Fed had policy rates at 0 and they were doing rounds of quantitative easing. I mean, that's a harder call to make sitting where we are today. But, going back to 2018, 2017 levels of interest rates, I think is definitely on the table, John.
Emily, do you agree?
Yeah, I do. If you look back at the last 4 cycles, we just did some work on this at John Hancock. We have seen a 10-year Treasury yield tends to peak about 3 or 4 months before the Fed funds rate, and then both fall precipitously into the recession. In fact, the 10-year yield falls on average of about 2.6%, again, over the last 4 cycles. So that brings us down to 1.5%, 2% on the 10-year, and then the Fed funds rate falls an average of 4.25%. So that gets us back down there. Look, nothing has changed in terms of the economy, except we pumped trillions of dollars of fiscal stimulus into it, and we had a supply side shock. We have forces out there that are wildly disinflationary around technology, around demographics. We think we'd go back to that environment, which, by the way, was a good one for stocks and a good one for bonds. As we get through some of this, as we get rid of this extra stimulus, as liquidity gets pulled from the system, money supply comes down, we get back to that low growth, low inflation environment we've been in for much of the last decade.
Emily, what happened to that argument about a secular shift, deglobalization, the energy transition, all of those things and more that meant that people were arguing for higher inflation for longer?
I think you could see some of those trends bring inflation up modestly, especially around deglobalization. We look at onshoring or reshoring as being a major fundamental or secular trend in the markets, as there's an increasing recognition from CEOs in the U.S. that if you're going to sell something here, you're going to make it here. That was a trend that was in place, though, prior to the pandemic. Yes, it's been accelerated. And as it relates to the commodity complex in a global recession, which, by the way, is where we think we're going, oil prices come down. Yes, the supply side is a little bit different, more constrained, but we do see downside for oil prices from here, too. So I think those forces, yes, could moderately push up inflation, but those more secular, longer-term forces around technology in particular are likely to bring it down.
This is one of the big conversations for the week down in Washington, D.C. at the IMF meetings. I'll continue them with you. For the whole of the team as well, we'll continue them as too. Emily Rowland, Matt Hornback, to the two of you, thank you. I want to pick up on a note from Michael Hartnett of Bank of America. He said, sell the last hike in his recent note. He said investors are too optimistic on rate cuts and not pessimistic enough on recession. We'll be talking about that with Nuveen's Tony Rodriguez in just a moment. The morning calls are coming up next. Then later, Tony Rodriguez expecting a challenging earnings season for the big banks. That conversation is still ahead around the opening bell. The big banks kick off earnings season later this week. It's JP Morgan on Friday. It's Goldman next week with all of the rest. And before we get there, it's CPI tomorrow morning and some Fed minutes too. Equity futures positive, a little more than 0.1% from Washington. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors who learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence. for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Was going to keep Green World Cup. This is a 3.
As the economic picture does.
Is it your case getting ready to make a decision?
Live from Washington, D.C., the opening bell about 5 minutes away. Up in New York City, equity futures right now positive 0.1%. The Nasdaq turning negative just a little bit. We're down not even a tenth, negative 0.05%. Let's get you some morning calls. First up, Goldman, upgrading Weight Watchers to buy, 132 price target, expecting the company's new obesity drug to serve as a turnaround catalyst. That stock is up in a massive way in the pre-market. Your second call from Baird, initiating coverage on Match Group with an outperform rating, seeing notable growth prospects stemming from its online dating platform. And your third and final call from Jefferies, upgrading New York Community Bank to a buy, highlighting the company's balance sheet positioning after its deal for Signature Bank. That stock up another 2.5% in the pre-market. Coming up, investors gearing up for big bank earnings on Friday. That conversation up next with Tony Rodriguez of Nuveen. Your opening bell just around the corner.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Moving towards the opening bell in New York City from Washington, D.C. this morning. Good morning to you. Equity futures just about positive on the S&P, up a little more than 0.1% positive on the S&P, just about. On the Nasdaq, totally unchanged on the Nasdaq 100, going into a big week for economic data and for earnings too. There's your opening bell. Switch up the board and get to the bond market. Yields look like this on a 10-year in America. Treasury yields basically unchanged on a 10-year maturity, 341.30 on a 2-year, down a single basis point, just sub 4% at 399 on a 2-year. This 2-year's been all over the place. Euro dollar positive, stronger euro. Euro dollar 109.20. We're positive there by 5 or 6 tenths of 1%. Also positive about 5 tenths of 1%. Crude, $80 and about 11 cents. 25 seconds into the session, equity shaping up as follows on the S&P, positive by not even 0.1 of 1%. The Nasdaq negative by not even 0.1 of 1%. I'll get you one stock to watch at the open. It's Newmont, the mining company making a fresh bid for its rival Newcrest. A record offer of $19.5 billion on the table. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, as you can imagine, this is big news in the world of gold mining. If completed, this would be the biggest takeover ever of a gold mining company. And as you would imagine, that price tag, that sweetened offer, has Newmont shares lower as trading kicks off, down about 2% or so. And Newcrest, of course, the company potentially being acquired here, shares higher just as trading gets underway, about 5% or so. So this fresh bid comes 2 months after Newmont's $17 billion all-stock offer was rejected. And the revised proposal has been heavily sweetened, John. Newcrest holders would get 0.4 shares for each share held. And the deal would also allow Newcrest to pay a franked special dividend of up to $1.10 per share. And all told, this represents a 46% premium to Newcrest's price before Newmont's initial bid back in February. And it's worth noting that Newmont, the bidder here, hasn't really benefited from gold's rise over the past 6 months or so. Newmont shares are down more than 37% over the past year, while gold itself is about 2% higher over that time, John.
Katie, thanks for that. I appreciate it. That stock is positive by a little more than 5%. I want to turn to tech. China drafting plans to mandate a security review for AI services like ChatGPT. This is Alibaba unveils its new service alongside Baidu and SenseTime. Back with us for more. Here's Kaylee. Hey, Kaylee.
Hey, John. Well, we know that all of these companies have been racing to offer their own AI kind of chatbot services. Maybe China wants to slow things down, but at the same time, as you said, Alibaba is planning to roll out this technology further in its equivalent of smart home speakers like the Amazon Echo, for example, as well as its own Slack-like office software, which is called DingTalk. And the CEO of Alibaba said that the language model will be incorporated across all products and services in the near future, though he didn't give an exact time frame. Maybe if you ask China, that time frame should be extended, because we understand that Beijing is looking at proposing rules to make sure that companies conduct security assessments before rolling out this technology, including calling for efforts to ensure that the content generated by AI is actually accurate, and also to have a disclosure when content is AI generated. They are accepting feedback on those rules until May 10th, so we'll see what the outcome of that is. And if it could potentially sap the rally we have seen in some of these AI-sensitive stocks. We know that tech has been outperforming largely. That is true in China as well. But the 12% gain or so we've seen for China's tech stocks, not a lot to sneeze at compared to what we've seen for NVIDIA, for example, one of those AI-sensitive names, up 89% this year, if you can believe that. And of course, that's helped lift the stocks and NASDAQ 100 indexes into bull markets.
This has been a really hot part of the equity market. Katie, thanks for that. Broader market looks like this. About 3 minutes and 30 seconds into the session, we are positive on the S&P 500 by almost 0.1 of 1%. The tech-heavy NASDAQ down by not even 0.1 of 1%, just slightly negative. I want to stick with tech. Tim Cook is said to be scheduling a trip to Apple's first stores in India, with openings scheduled in Mumbai and New Delhi next week. Ed Ludlow joins us now with more. Morning, Ed.
Yeah, good morning, Jonathan. According to sources, Tim Cook will preside over the openings of Apple's first physical stores in the country, the first being in Mumbai, the second being in New Delhi. Those dates for the opening, the 19th and 20th of April, respectively, have been confirmed by Apple, but Tim Cook's trip to the country has not officially been confirmed. It's really interesting. You know, Tim Cook first went to India in 2016. It's a market they've made progress in. The online store was launched in 2020, but as you can see from this chart, it's included in the rest of APAC region, which is just 7% of sales. That said, iPhone sales in particular have hit record highs coming out of India. It's a market, the second largest smartphone market, where the higher end price point has not resonated with some of the consumer base in India, which is obviously massive. But look at it another way. Exports of iPhones from India in terms of assembly have reached the billions of dollars now. So while sales growth has been inconsistent in that market, we know that it's a big part of Apple's strategy to move supply chain away from its dependence on China to India. You will have seen Mark Gurman's report last month about them restructuring the sales and retail teams within Apple so that India is more of a standalone unit, and clearly that is a top priority for Apple. Bit of a service announcement this morning. A number of Apple services have been down, thousands of reports on Down Detector. Apple's reports say they're working on it. The stock is completely flat and treading water. I'm not sure how much of an impact those down or outages are happening.
Ed, I know this has been a feature of the conversation between you and Caroline Hyde on the technology program that we do every single day at midday. Ed, when it comes to Mark Gurman's story, can you build on that just a little bit more? Tim Cook, to me, feels like and sounds like a phenomenal diplomat. He's able to make these moves just behind the scenes without upsetting the host country we're talking about. Just what is he doing differently to the rest?
Well, there was two key pieces of reporting that reflect that, John. So as we know, Tim Cook was in China 2 weekends ago, where he met with the new commerce chief and also spoke publicly about Apple and its role in China. But we know, according to sources behind the scenes, other executives, particularly supply chain teams, are really trying to move away from China, in part because of the supply chain risk that emerged in the second wave of COVID last year, particularly in Zhengzhou, where the Pro models of the handset are assembled, but also politically, right? There's an awareness that tensions between US and China are essentially at an all-time high, and Apple doesn't want to get caught in the crosshairs. They also want to make new friends, and that's part of this story about Tim Cook going to India for the new retail stores. There's opportunity for sales growth, but remember, they're also trying to get more of their components assembled in that nation as part of supply chain diversification strategy.
Hey, Ed, looking forward to the show a little bit later. Ed Ludlow there on the latest for Apple. Want to turn to earnings season, big feature of this week's programming with JP Morgan coming up on Friday. CarMax topping Q4 profit estimates with cost-cutting measures helping offset weakening demand. The company's saying this: we believe vehicle affordability challenges continue to impact our sales performance as headwinds remain due to widespread inflationary pressures, climbing interest rates, and prolonged low consumer confidence. Isabel Lee joins us now with more. Hey, Isabel.
Hi, John. Yes, CarMax is soaring around 4% this morning. The company basically beat Wall Street earnings after squeezing enough profit from each used car and also countering a sales drop and softening price in used cars. So CarMax reported an adjusted profit of 44 cents. That's well above the 20-cent estimate, but it's not even half of the 98 cents we saw a year ago. The company is benefiting from the stabilization in pre-owned vehicles. That's after sliding much of last year. But this also means fewer transactions because some buyers are obviously going to be put off by these higher costs. And to your point, vehicle affordability is indeed a challenge with soaring inflation, tightening monetary policy, and low consumer confidence. The stock, however, has climbed around 9% year to date. But broadly speaking, shrinking margins have been dragging earnings of auto retailers. For instance, Carvana last month said it expects to see lower sales volumes offsetting higher gross profits. So we'll see, as you said, this kicks off the earnings seasons, and we'll see a lot on Friday.
The stock is up by more than 7%. Isabel, thanks for that. The broader equity market right now, about 8 minutes into the session, positive by not even 0.1%. Really, really muted price action. Want to take it from autos to financials, looking ahead to big bank earnings kicking off on Friday with JP Morgan, Citi and Wells Fargo. Nuveen's Tony Rodriguez sounded the alarm ahead of the results and writing this: we believe financial sector earnings will be pressured, consistent with decreasing 2023 earnings growth estimates since the start of the year. Banks will be facing regulatory pressures on capital and liquidity, as well as increasing competition for customer deposits. Tony Rodriguez, I'm pleased to say, joins us right now. Tony, is the conclusion here ultimately, and welcome to the show as always, sir, is the conclusion ultimately that this is going to be a less profitable sector with the changes that you expect?
Well, good morning, Jonathan. Good to be with you. And we do think that for the balance of this year, there will be earnings pressure. You know, we mentioned about rising costs for deposits And we're also seeing that there's going to be pressure on the lending side as there's going to be greater conservatism across, we think, the banking industry from the loan side. And of course, these rising rates, we know that has pressured their balance sheets. You see the unrealized losses that are on the balance sheets of all these companies. So we take that to mean that from an equity market perspective, we think it's going to be pretty challenging for the financial sector. When we look at the fixed income space, however, we do think that their balance sheet strength, while we're going to see some weakness clearly on asset quality, it is really at a very, very strong level, and we think will support financials kind of through the balance of this year, through the bottom of this economic cycle that we're expecting to hit towards the end of the year, early next year. So on the fixed income side, we think there are opportunities in financials, but earnings will be a headwind for financials across the board.
Tony, something you said, we expect to increase risk over the coming quarters as wider spreads offer better entry points. That's always the hope, Tony. It's always the hope. Are you actually going to get those wider spreads, and what do you think the catalyst is going to be for them?
So we think that the catalyst is going to be a greater appreciation for the economic weakness we're expecting to see in the fourth quarter and early next year. So our call is that this tightening in financial conditions, all of the Fed rate increases that we've seen, we're going to begin to see a slowdown in the consumer, and that is going to drive what we expect to be a relatively mild, short recession. But right now, we don't think that valuations necessarily fully reflect that. So we're not expecting a washout by any stretch, as you might see in a very hard landing, but we do think that you'll see some modestly better entry points as we move through the balance of the middle of the year here, given expected volatility to continue in the marketplace. And we think that weakness in the equity market will reverberate a bit into the fixed income space as well, leading to some wider spreads for risk assets.
Tony, out of interest, what kind of levels are you looking for?
Yeah, so Jonathan, if you look, say, what the high spreads were back in September, October, we think we can get back to that level for the investment grade marketplace. For the high yield market, we don't think we'll necessarily retrace all of that. So that puts you in the context of maybe 25 basis points on the investment grade market in credit. When you look at kind of high yield leveraged loan space, you could see somewhere in the neighborhood of 75 to 100 basis points of widening. That will still lead to a very attractive total return outcome for investors, because starting yields here, if you look at below investment grade, we're talking 6.5 to 8.5 or 9% yields. So we think the market is pretty well positioned for mid-single to maybe slightly upper single-digit returns out of those below investment grade spaces. And we think that's an attractive return relative to equities and competing assets.
Tony, right now the Treasury market is priced for interest rate cuts. You're well aware of that. The equity market, some parts of it, have taken comfort from those interest rate cuts. Michael Harnett of Bank of America said investors are too optimistic on rate cuts, not pessimistic enough on recession. He said sell the last hike. Now, when you think about selling the last hike, Tony, you've got to work out what will be the last hike. Have we seen that already at the last meeting, or is the last hike still in our future?
So we think that the last hike is still in our future, and we think it'll come at the May meeting. From there, we do think that the Fed is going to be on hold, most likely for the balance of the year, even though we do think there's a possibility that by the end of the year, call it the December meeting, there may be the first cut, but otherwise it comes in the first quarter of 2024. So we think it's an on-hold Fed after this next 25 basis points for the balance of the year. And we think that the economic weakness that we're expecting is going to be a significant headwind when we look at the equity market in particular, and when we look at corporate earnings. But we do think that as we turn the corner to 24, you have a better outlook. And in fact, the data tells you that at the date of the last hike, forward-looking returns for the ag, for short treasuries, for example, all are positive. So the best entry point from a timing perspective in terms of total return is typically the date of the last hike. So we think that will be in May. And so we think that there'll be some better entry points, as I mentioned, from a risk asset perspective, but from a total return perspective and our view about underlying kind of high quality treasury rates, we do think we'll see lower yields at the end of the year than where we are today.
Tony, appreciate your perspective. Always do. Tony Rodriguez there of Nuveen on this equity market and on credit too. and on the Federal Reserve. 14 minutes into the session, equities just about positive by like that much on the S&P 500. The Nasdaq, the tech-heavy story, just a little bit softer this morning so far. As I keep repeating, back to the calendar, CPI tomorrow, Fed minutes, then through the week, some bank earnings too. Coming up next on this program, the US walking a fine line with China.
The U.S. is not seeking to decouple from China. We're not seeking to limit China's growth.
The United States and the Philippines kicking off its military drill after China concludes its own. More on that up next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We occasionally or frequently have issues with different economic policies in China, and we will always defend U.S. economic interests as well. But we're not in any way trying to separate these two economies entirely. That's just neither practical nor in our interest.
Major economies walking a tightrope as U.S.-China tensions remain elevated. The U.S. and the Philippines kicking off one of their largest military exercises in more than 30 years. The Chinese Foreign Ministry issuing a response saying the two nations, quote, must not interfere in South China Sea disputes. This coming as the French government walks back President Macron's remarks calling on Europe to stay out of the conflict over Taiwan. Our team coverage starts right now with Bloomberg's Anne-Marie Tadeo, both here in D.C. This is nice. The team's back together. Maria, let's start with Macron's comments. What kind of walk back have we seen so far?
Well, we're about to find out because, in fact, he is giving a speech in about 30 minutes at The Hague when he will talk about the future of Europe. So he went on this trip. Obviously, a lot of the issues started not so much on the trip, but on the way back. So he took a couple journalists, but this is typical Macron. There's nothing here that's unusual. So he decides, I will talk to maybe 3 or 4 reporters. We do this interview, and then on the way back, we debrief the trip. Obviously, there was that political story, which was controversial. The comments on Taiwan, obviously, were controversial. The timing of it was very bad because we knew that China was doing all this maneuvering around. And then, of course, there was a quote check at the end of the article, which said he made even more comments, but we could not print them because the Elysee, so the French palace, did not approve them. So now what we are seeing here, particularly in D.C., not so much in Europe, is French officials suggest a lot of this misinterpretation. People just don't get it when he speaks. This is also something we hear all the time. Like, the press just doesn't get it. He speaks in a way the reporters do not get it. But at one point, there's a very fair question. If nobody understands what you say, is it you or the press that is simply too stupid to not get your comment?
I think the argument might be it's you, it's the messenger, and I would go one step further. For the United States, if the U.S. administration used the language that Macron used in that conversation, if they turned around and said, we don't want to get involved in other people's crises, and they were talking about not Taiwan, but what was happening in Europe, on Europe's doorstep in Ukraine with Russia, what would the Europeans say back?
Look, in Ukraine, that would have been fatal. It would have been fatal for the Ukrainians because we know they care so much about what the U.S. does. We know what they do with the weapons. We know what they do with the funding. Obviously, Europe was wrong-footed by the timing of the war, the energy. They were still plugged in to Russian energy. When it comes to the weapons, obviously, we know they provide weapons for Ukraine, but it's smaller compared to the U.S. So that would have been incredibly fatal. And again, that goes back to the criticism to Macron. You can have many opinions. You can say, yes, we don't want to compete with the U.S., but we don't want to be a rival to China either. We want to be a third way in between. But you have to be able to back it up. And the issue is that for Europe, well, on the weapons, they don't have it. We know that when it comes to the monetary and banking union, that's not completed. There's many visions of what Europe means. And also, I would say, when he speaks on behalf of the French Republic. That's very important to understand. He does not reflect the consensus on the EU, because I know there's many other politicians that are very angry about the comments that he made, particularly in Eastern Europe. That did not go down well.
Anne-Marie, what's the response been?
Well, you saw what Marco Rubio put on Twitter, the Senator Rubio, and to your point that not all politicians are happy with what he said, Marco Rubio certainly wasn't, and he asked, are you speaking on behalf of France or are you speaking on behalf of Europe? Because if you're speaking on behalf of Europe, we have a big problem. The U.S. is in charge of your defense, and the U.S. can also look at the comments you made about not being able to choose a side between the United States and Beijing when it comes to Taiwan, that maybe the United States should not be choosing a side when it comes to a European war, Ukraine. He says, I supported sending that money there. This is American tax dollar money. But if you're not going to back us, why should we back you?
Won't that be the argument in the presidential race, or at least on one side of the race here in Washington, in the next 18 months?
It certainly will. Ukraine will be a huge discussion point. We've already seen a lot of Republicans saying potentially we need to slow down some of this funding. Why are we spending all of this money on Ukraine? But also Taiwan, and how this administration versus potentially how the Republicans will handle combating China, and especially what happens in Taiwan. This will all be about 2024. But also to Maria's point, Macron, when he made these comments, the timing was awful. Not only was China just having military drills, if you look at what's going on right now, in this hour, they are continuing military operations. So the timing of this was really fraught for this relationship.
You know what we're not talking about? The mess in France. And maybe that's some good news for Macron, just a tiny bit. AMH, Maria, to the two of you, thank you. Just a broader price action, unchanged on the S&P. Here's the sector price action. Here's Katie.
John, a quick look here. You have 7 sectors in the green, 4 in the red. Leading the charge to the upside is materials, it's healthcare. To the downside, once again, it's technology, down by 0.7%. This has been the theme of this week so far. Only 2 days in, that sector off by 0.9%, lagging the equal weight index. We'll see if that continues as some of these earnings kick off.
Katie, thank you. Thank you for that. Appreciate it. Coming up, your trading diary, a packed week coming right up.
transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
This is Bloomberg.
If you were looking for a day full of boring price action, so far so good for you. With one warning, it might change later this week. Look at this trading diary. Coming up, Fed speak throughout the day, Kashkari and Harker, followed by Barker and Daly on Wednesday. Plus the main event, US CPI and Fed minutes. Coming up tomorrow, US PPI and another round of jobless claims come up on Thursday morning, and another round of US retail sales coming up a little bit later in the week. On Friday's the big one, JP Morgan, Wells Fargo, Citigroup earnings to round out the week. From Washington, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Pepsi's Number Fever campaign in the Philippines
has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Vaynergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Vaynergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet.
Connection lost.
Global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been